have given you my mobile number. You can contact me at any time. So to clarify, you can contact me at any time. And then you try to keep it in your memory. Because these things are very basic for a credit management professional. What we are learning here are basic things and very, very important. So you must keep it in your memory. In the case of memory, there are two types of memories I generally tell to my students. One is the temporary, other one is a permanent memory. So when you study a thing, if you understand that thing, maybe in this diploma in credit management, or what we are teaching or what we are explaining, you must keep, it will go to your temporary memory. And it will be there for a maximum of 4 or 5 days only. After that, you must transfer what is in the temporary memory to your permanent memory. So there are certain ways to transfer this. So one is, today morning you are learning these lessons. So in the evening at your dinner time, or yes, maybe when you are sitting, you can just recall what we have learned today. That is the major subjects, major headings, what you have learned today. Yeah, we have learned banking history in Sri Lanka, and then sources and uses of bank funds we have learned, and we have learned asset and liability management in the financial institution, and then we have learned who are the customers, the type of customers who will come to the lending institution for financial assistance. Like that, you will list it. You try to recall it. And then, at least the headings, the subjects, subheadings you learn. You memorize. You bring it to your memory. And then, maybe after 1 or 2 days from the session, you go through. Right. Then, little by little, it will, those things, items will transfer from your temporary memory to your permanent memory. This is, you can do it in 1 week time. And then maybe the second time, after 2 weeks, you go through it. Then it will go permanently to your permanent memory. That will be there. It cannot be erased. So this is a system you can follow. Now, because what you are learning here are important for your career as a credit specialist in a financial institution. Okay, I hope you will follow it. Anyway, all the best for you all. I hope you will do very well in your career as a professional credit managing specialist. Okay, today we follow. Continue. This is module 1, as I explained to you earlier, principles of credit management, lending policies and best practices. Right. Today we are going to learn something about guidelines for good lending. Guidelines for good lending. So there is the traditional security-based lending versus skill-oriented cash flow-based lending. Actually, in the past, the lending was a traditional security-based lending. When you go to the bank for a credit facility, they will ask the manager or the creditor, okay, before anything, what is the security you have to provide for this facility? What is the collateral you have? So then you will tell this and that and this type of security. Then only they will go on. So that was the traditional security-based lending. So from that one, we had to move. And now mostly, now we are following skill-oriented cash flow-based lending. So we will work out the cash flow-based lending, whether the customer has sufficient cash flow, whether he can create sufficient cash flow to repay that facility which you are going to grant. For that one, you need skill. You have to develop your skill. That's what we are doing here in this program. That's what we are doing. for you to get this skill. So it is going to be a skill-oriented cash flow-based lending. So we had to move from the traditional security-based lending to skill-oriented cash flow-based lending. But I won't say don't take security. No, you will be taking. First, of course, you see whether the borrower will have a repayment capacity, whether the borrower will have cash flow, generate cash flow to repay that facility. And then, yes, if there are any risk element involved, you will ask for a security. Depending on the risk, nature of the risk, you ask for the collateral or the security. So that's what we say now it is two ways out lending. Now we are doing two ways out lending. The first way, cash generation within the enterprise. If it fails, unfortunately, if we are doing everything up to our knowledge, satisfactorily, everything we are doing, calculating, doing the analysis, everything, and we are satisfied the cash flow is there, sufficient cash flow will be generated, so the customer can repay that facility. But unfortunately, if anything happened, then the second way out. So first way out is cash generation within the enterprise, and sometimes, unfortunately, if it fails, then the second way out, realization of the security. So for that purpose only, we are taking the security. So rather than thinking the security first, now we must see whether the borrower will have sufficient cash flow, generate sufficient cash flow to repay the loan. But unfortunately, if it fails only, we will go for the security. For that purpose, we will obtain the security or collateral. Okay, right. Lending principles and best practices. So our lending, we have certain principles. For quality lending, we have certain principles. And best practices we have to follow to ensure our lending is quality lending. So these are some characteristics of this quality lending. One is safety of the funds we are lending, then liquidity, profitability, then the spread of our lending, that is portfolio, balanced portfolio, purpose for which we are granting the facility, end use of the facility, then need-based finance, then viability-based instead of security-based, own stake of the customer, and finally, national priority. So there are about 10 characteristics which you have to ensure when you are doing lending, or you are lending to be a quality lending. We see one by one. Safety, major concern for the banker. That is, what you are lending should be, yes, you must collect it back together with the interest. Your fund, but you are lending should be safe. It should be safe. Major concern for the banker. Major concern for the banker. The safety of the funds which you are lending. Ability of the banker to critically assess the borrower's capacity to repay the borrowed amounts together with the interest, for which you have to develop your skill, analyzing skill you have to develop. That's what we call it, skill-oriented lending. So, ability of the banker to critically assess the borrower's capacity to repay the borrowed amounts together with the interest within the time frame, stipulated time. So thereby, the lender, that is a banker, credit officer, ensuring the safety of the fund. In present context, this factor is very important because there are problem credit with some banks, NPAs, non-performing advances, the increasing percentage of non-performing advances, which we call problem credit default. Because of the default, our fund lend may get jeopardized. So you have to ensure safety of the funds which you are lending. So this is the important characteristic of a quality lending. Then the liquidity. Bankers' ability to get the advances liquidated expeditiously. That is, what you are granting, you must recover it. Within the stipulated time frame, you have to recover it. That is liquidity. Financial intermediation, we have explained in our previous lecture program. Financial intermediation. The banks are mobilizing funds from the depositors and granting to the borrowers. Customers' deposits should be paid immediately or at short notice. In this case, the liquidity means whenever the depositor comes and asks for the fund, you should be in a position to pay that one. Otherwise, the liquidity will be lost. The liquidity will be lost. So, in the case of financial intermediation, you are mobilizing funds from your depositors. So, that should be paid when they are demanding, when they come and ask for their deposits. So, if it is not there, if the institution, financial institution is not in a position to pay that rate, then the liquidity problem, that institution may collapse. That's what has happened to many bank failures in the past and the recent past. Many banks failed because they lost their liquidity. When the customers come and ask for their fund, they were unable to pay it back. So because their investment, maybe they have granted loan facilities, maybe they would have invested in various ways, maybe in shares, subsidiaries, various other businesses, they would have invested. So they cannot collect it back. So when they collect it back, they won't be able to pay back the customer's deposit. They lost their liquidity. They lost their liquidity. This may lead to the failures of the bank, collapse of the bank, collapse of the financial institution. That has happened. You would have seen. What has happened to the Pramuka Bank, what has happened to the Golden Key, and so many finance companies in the past, they lost their liquidity. So this is also very important in the present context because the NPAs and the problem loans, the investment made by these financial institutions may be unrecoverable, failed. So because of that one, the financial institution lose its liquidity. So liquidity is very important concern for the quality lending. Then the profitability. It is a key element for any business, including banking. So profitability is because they are doing the business, including the banking, for the profit. So profitability is an important thing for any element, any businesses, including banking. Sound business decision, cost of funds, transaction cost, other related risks you must consider. You must consider to make your lending program for profitable. It should be profitable. You have to ensure your credit, what you are lending, that business should be profitable. So generally, I used to ask my the participants of this program, profitability is important for a business organization. Liquidity also important for a business organization. Both are important. But which is more important, whether profitability or the liquidity is the most important thing for a business institution. Maybe any business institution, including banking, whether profitability or the liquidity, which is more important. Obviously, yes, obviously, liquidity is most important. Profitability also important, but liquidity is more important because when an institution loses its liquidity, that institution will collapse. So it is very risky in a short-term basis. Loss of liquidity is high risky for the business institution. It will collapse immediately. In short term, the institution will collapse when they lose their liquidity. In the case of if the profitability is lost, the institution may run for some time. It will collapse in the long term. When the institution loses its profitability, it will collapse, but not in the short term, but in the medium or long term, the institution will collapse. But when the institution loses its liquidity, the institution will collapse immediately. Short-term basis, in short term. So now you understand the profitability, importance of profitability and importance of liquidity. So this is another characteristic for a quality lending. Spread of funding, that is balanced portfolio. When you are granting credit facilities, so we call it portfolio, credit portfolio, various areas, various sector you are granting. So we call it credit portfolio. The credit portfolio should be well balanced credit portfolio. In other terms, the spread, we call it spread, that is balanced portfolio. There's sometimes people used to say, business people used to say, you should not keep all the eggs in one basket. If anything happened to the basket, you will lose all the eggs. So they advise you keep the eggs in different basket. So if something happened to one basket, there are other basket where you can have the eggs. So should not concentrate to one sector or industry or field. When you are granting, you should not concentrate to one sector or one field or one particular industrial sector. So you must balance it. Maybe agriculture sector and maybe industrial sector, tourism, import, export, SMEs, corporate, various sectors, you must maintain a balanced portfolio. If anything happened to one particular sector, you can save from the other sectors. Only that sector will get affected. So we call it concentration risk. If you are concentrating to one particular sector, we call it as concentration risk. Similarly, strike a balance among short-term loan, medium-term loan, long-term loan. You should not concentrate only in short-term loans. You should not concentrate only in medium-term loans. So you must say, short-term loans also you must give, and medium-term loans, long-term loans, yes, all these things you must give it in a balanced way. So this will be looked after by the ALCO we have explained in the previous lecture. Asset and liability committee will look into all these things. So you must maintain balanced portfolio. Strike a balance among short-term, medium-term, and long-term loans. Right, you can follow it now. I'm sorry for the interruption. So the credit officer must ensure he must strike a balance among short-term, medium-term, and long-term loans. So different sectors, you must have a balanced credit portfolio. Similarly, the terms of the loan with the short-term, medium-term, and long-term also, you must have a balance. Thereby, you are ensuring a balanced portfolio, credit portfolio. For your lending to be quality lending, yes. Then the purpose. Purpose also important. For what purpose you are granting the type? Lending for approved purposes. So the approved purposes, it will be mentioned in your, yes. Okay, lending for approved purposes. One is for productive and consumption purposes. Production loans and consumption loans for productive and consumption purposes. So productive may be agriculture, industry, various, and consumption purposes. Not for speculative purposes. Similarly, not for illegal purposes. So speculative purposes, what do you mean by speculative purposes? Where you are not sure about the end results. Some purposes where you are not sure about the end results, whether you will gain or lose. We call it as speculative. So that type of purposes, speculative purposes. One is horse racing. Some people go and deposit money for horse racing purposes. Sometimes the particular horse may win or lose. If the horse win, you will gain. If the horse lose, but you are not sure whether that horse will win or not. Win or lose. Similarly, gambling. It's speculative purposes. They go and put the money in gambling table, thinking they will win, but they may lose. So speculative purposes, for speculative purposes, no lending. But there is one speculative purpose is there, that is share trading. Some people buy shares and sell, thinking they will gain. Some people buy shares and sell. That is, we call it margin trading in banking. For the margin trading, the banks are granting facility for their best customers. For margin trading purposes, banks are giving facilities, credit facilities for those customers to purchase shares and sell in the share market. They are granting facilities. But not all customers, their best customers, they are granting. So this is speculative purposes, but for which banks are granting facilities for their best customers, because those customers have so many avenues of income. So many avenues of income, those customers. Even if they fail in these speculative purposes, there are other sources of income from that they can settle this facility. Because of that only, those best customers are being granted facilities by the banks, financial institution. Not all the customers. And then not for the illegal purposes. Not for the illegal purposes. There are so many illegal purposes. Yes, for those purposes, banks won't grant. So the banks are granting facilities for productive and consumption purposes. When it is productive, so many things will come. All the legal things will come. And the consumption purposes, agriculture, industry, tourism, hotel business, all those things, yes, will come. Production of products and services. Productive purposes mean products and services. So, banks should formulate a lending policy in respect of purposes. Yes, we will be doing the credit policy document maybe later, or maybe in my next session, we will be doing the credit policy document of a financial institution. It's very important. That gives the guidelines for the credit facilities, type of credit facilities, how to disperse, and all the details are there. We will be doing it. So the purposes, what type of purposes for which the banks can grant the facilities is stated in their credit policy document, which we will be doing later. So the purpose, that is also another important characteristic for a quality lending. End use of the fund. Bankers should ensure that the money lent has been used for the purpose for which it was granted. The banker should ensure that the money he is giving for a purpose to the customer as a credit facility should use for that particular purpose. So that means he has to carry out an inspection after granting the facility and see whether it is used for the particular purpose for which it was granted. Why is that? We are granting, if he is having the repayment capacity, we have calculated and everything, we have done the analysis. Yes, he is having the repayment capacity, so he can repay. So why we have to worry about that one? No. Well, a customer is working in a company. He and his wife also working. Both are earning some good amount of salaries. They have 2 children, they are schooling. Now they don't have their own house. They are living in a rented house, for which they are paying about 50,000 rupees monthly. Now they want to go for their own house. They are approaching a bank, giving all the necessary information, documents, everything which the bank asked for. The bank also satisfied. They have they both are within the age limit and they have sufficient surplus to repay the facility. The bank is agreed to grant the facility and granted 5 million rupees loan for them to purchase a house. Instead of purchasing the house, if we go and purchase a BMW car, a very high-priced car, then what will happen? He has to pay the loan. And he has to continue to live in the rented out house, for which he has to pay the rent. He has to look after children's schooling expenditures and their living expenditure. In addition, they have to maintain the car. Will they have surplus to repay the loan? No. Can they live in that car itself? Husband and wife and the children? No. Then what will happen? The loan will get default because they won't be able to pay back the loan. Their expenditure will go on as it is as earlier. So in that case, what will happen? The facility will get defaulted. They won't be able to pay back. So the lending institutions see whether they are purchasing that house for which they have granted the family. Then only they can save what they have paid rent earlier. They can save that money and they will be able to pay back the bank loan. So because of that one, end use of the fund, the bank should ensure, which is also very important. But there is an exception. There is an exception. In one type of loan, banks are not asking for what purpose you are taking. Banks are not asking, and they are not carrying out the inspection and see whether they are using that money for that purpose for which they have requested. No. What is that type of loan? One particular type of loan. Banks are not looking into the end use of the fund. Actually, this was started sometime back, about few years back, by the HSBC only started this one. We are granting, you use it for any purpose. Yeah. And then all other banks follow that suit. All other banks also follow. Even DFC, CNDB, I have seen in their lifts also there. Yes, we are granting this loan, you use it for any purpose. Big advertisement. All other banks also followed it. The loan for that called as personal loan. Personal loan, the banks are not looking at the end use of the fund. Because this loan is granted to salaried employees, permanent salaried employees, who will get the monthly salary, and with the salary, they will have the surplus and they can repay. So bank is making ensure that they are permanent employees and they are getting salaries. The salaries, they have the surplus. With the surplus, they can repay the loan. So they are not worried whether they are purchasing the house or whether they are purchasing a car or whether they are going abroad on leisure trip. No. So this is the only exception. So reason also, I have told you, in all other cases, except for the personal loan, you must see the end use of you must ensure end use of the funds which you are granting as the credit facility. Need-based finance, other characteristic of quality lending. Need-based finance. Banks should ascertain the credit need of the borrower and lend accordingly. So you must calculate and see, you must ensure what is the actual requirement of facility for this particular customer, depending on the purpose. What is the actual requirement? So accordingly, you must grant the facility. Accordingly. Overfinancing also bad, underfinancing also bad. Both are bad. Overfinancing, he will have excess money. He may go and spend the money on some unproductive purposes. And then he will have difficulty in repaying the loan. So overfinancing, bad, because he will have excess fund, he will utilize for the purpose, and then he will have excess fund. He may go and use it sometime, he may go and use it for unproductive purposes. So because of that one, he won't be able to settle the loan. So this is overfinancing also bad. Underfinancing also bad, because for the purpose for which he obtained the facility may stop in the halfway because he don't have sufficient fund to complete it. So there also the work is not completed, thereby he won't be able to get the anticipated income, so he won't be able to pay back the loan. So overfinancing and underfinancing both are bad. I have seen in the case of some customers' case, the bank managers had made mistakes. The customer wanted some maybe 10 million rupees to complete his industry. But the manager, of course, just to, without doing the calculations and everything, he would have done the calculation, he would have analyzed, then of course he may know that yes, actually he needs 10 million rupees, but for easy way, he has granted, get the mortgage and granted 5 million rupees. That poor fellow also started the industry, I mean, construction, work up and everything, that stopped in the halfway. He couldn't complete it. So he couldn't get the anticipated income. He couldn't repay the loan. This has happened. The fault of the managers. This has happened. So overfinancing also bad, underfinancing, both are bad. So managers should develop their skill to assess all these things. Managers and the credit officers should develop their skill to assess these things. So this is need-based finance. Viability-oriented lending versus security-oriented lending. This I have explained at the beginning today. Yes. Instead of security-oriented lending, cash flow-based lending, cash flow-oriented lending. That means viability. The business or industry, whatever the things the customer is going to start, it should be viable. It will create sufficient cash flow. The advances should be granted based on the profitability of the business and the credit worthiness of the customer. Security-oriented insurance. Security only acts as a psychological support to the banker. Yes, the bank manager will think, yes, I have taken a good security, so the customer will repay it because the customer will have attached some value for his property. Customer may have some value for his property, social value, or maybe his property. So customer some more rather pay back. That's a security only act as a psychological support to the banker and pressure on the borrower. So the security-oriented lending will come as the second way out. So primarily, the manager or the credit officer should look at the viability of the venture. So we call it viability-oriented lending versus security-oriented lending. On stake. Borrower should have a reasonable financial contribution in the business or the venture. So when a customer comes for the facility to do a business or a venture, industrial or agriculture, whatever it is, and he also should put some money in it. So he also should have a reasonable financial contribution. We call it equity contribution. Equity contribution. Maybe the banks are asking about 25 to 30% or more from the customer. Minimum of 25 to 30% from the customer for his business. The balance, if everything is acceptable, the balance the bank can finance. So this is, we call it own stake. The reason when the customer put his own money in it, he will have created interest in the business because his own hard-earned money also in the business. So he will be thinking very carefully about the business and try to operate the business in a successful way. So own stake of the customer, that is equity contribution of the customer should be their own stake. Then national priorities. Actually, we must give some weightage for the national priority, that is priority sectors. We call it priority sector lending. What are the priority sectors in Sri Lanka? agriculture, industry, fisheries, tourism, exports. These are the priority sectors. Housing, these are the priority sectors. So the bank should allocate certain percentage of their credit portfolio, what they are lending, to these priority sectors also. So bank, whether it is state-owned bank or private bank, they must give some preference for the national priorities. So at least certain percentage of their lending should be granted for priority sectors. But now there are a central bank direction to allocate certain percentage of their credit portfolio lending to these priority sectors. There is central bank direction to all banks in Sri Lanka. Not only in Sri Lanka, even in America, banks have been directed by the Reserve Bank certain priority sectors to grant certain percentage to the certain priority sectors, especially housing purposes. A certain percentage, 5 to 10% of their credit portfolio should go for housing sector in America. So, similarly, in our country also, priority sectors should be serviced. Certain percentage should be allocated for these priority sectors by the banks. So these are the quality lending, characteristics of quality lending. So the lending credit officers should know these things. They should know all these things. Now, even in examination point of view, you may get a question, quality lending. What are the characteristics of quality lending? Maybe you may get a full question. So where you must mention these all 10 characteristics and you must explain it. Full question, what do you mean by quality lending? So simple question, but you have to write all these things. Sometimes it may come as a short note question also. The short note questions also there sometimes. So then you can mention the important things about the quality lending. Okay? Yes. Quality lending. There are 10 characteristics you must know. Now, we come to lending proposition. The specific lending or borrowing proposition should come from the customer. When a customer wants to borrow, the banker must reach a decision about whether to respond favorably or not. So, the specific lending or borrowing proposition should come from the customer himself. The banker or the manager or the credit officer should not force the credit. Take this loan on the customer. No. But he can explain the credit facilities available with you to a customer as a cross-selling. When we have last session, we have learned about this relationship banking versus transaction banking. You may remember. The relationship banking, when the customer to transact a certain thing with the bank, maybe to open an account or deposit some money, the credit officer can talk to him and may try to do the cross-selling. That means explaining the credit facilities available with us or the deposit scheme available with us, making him aware. So this is cross-selling, marketing as a part of marketing, cross-selling. That you can do. That is creating an awareness among the customers about the schemes which are available with your bank. That is cross-selling. But forcing a customer take this loan to achieve his target, the managers and credit officers, the branches have been given targets. You must achieve these things. So to achieve their targets on credit, they may sometimes force the customer to take this loan. No, it is not agreeable. So the specific lending or borrowing proposition, the borrowing proposition should come from the customer because he only knows what he needs. He only knows what he needs. So to suit that one, he will come and ask the facility. So when a customer wants to borrow, the banker must reach a decision about whether to respond favorably or not. A quick decision he has to reach, whether to respond or not. So banker should decide whether the proposition by the customer, the borrower, is acceptable as it is. Or customer wants 10 million rupees loan to purchase a house. So the manager will do the analysis and think, okay, we can grant this facility to him because he is creditworthy, he is having sufficient repayment capacity, his past dealing with the bank is acceptable and good, so he won't default, so I can give this 10 million to him. His purpose also, it is reasonable. He is living in a rented out house, he needs his own house, so we can grant this facility, 10 million. So that means acceptable as it is, or acceptable with some changes. Okay, customer is asking 10 million rupees for the housing purposes, but his repayment capacity is not sufficient enough to pay that 10 million rupees within the stipulated time frame based on his age and the repayment period. That 10 million paying the capacity, repayment capacity of paying 10 million is not that. So you can say, oh, sorry, you don't have sufficient repayment capacity to repay this 10 million rupee loan, but we can give you about 8 million for which you have the repayment capacity. So we can give you 8 million. The balance, how can you find out? So this is acceptable with some changes. Or not acceptable. He doesn't have any repayment capacity because he is not in a permanent employment. Sorry, we are unable to grant you. You are not in a permanent employment. So we are unable to give you 10 million rupees loan for this housing purposes. Not acceptable. So the manager, the banker should decide whether the proposition is acceptable as it is, or acceptable with some changes, as he explained, or not acceptable. So this decision he should make the decision quickly. For that, he has to develop his skill. He has to develop his knowledge and the skill. Lending proposition. Borrowing proposition. The customer must make clear to the bank, okay, the customer now he wants a loan. He is coming to the bank. He makes clear to the bank what he wants. Maybe he wants a consumer credit. So that, of course, he can make it very clear, a consumer credit, or maybe a personal loan or a housing loan he is coming. So what is the amount he needs? For what purpose he wants this facility? Repayment period, within how many years he can repay this loan? Source of income, what is the source he has to repay this loan? These basic information, the borrower, customer should tell the manager or the credit officer. When he come for a credit facility, these are the, say, for example, for a personal loan or for a housing loan, when he wants, the customer wants, when he come to the bank, he must give these basic information to the manager. That is, what is the amount he needs, for what purpose he wants this facility, what is the repayment period, within how many years he can repay this, and what is the source of income he has to repay this facility. Then the manager can take a quick decision. But sometimes this never happens. The customer comes, you would have seen some advertisement, paper advertisement or TV advertisement, where the financial institutions are saying, we are providing this facility, that facility. So after seeing that he is coming, he can take some loan, maybe for some purposes. So when he come to the bank, the credit officer asks, yes, how much you want? Then he says, so he doesn't know. Similarly, he wants to have good answers for this question. Generally, you can see the bank officers are facing this type of problem. Customers who are seeking credit facilities come without clear understanding, clear ideas for what purpose they are going to borrow. So in that case, the credit officer or the manager should advise the customer, look here, please go home and discuss with your home, wife and the children and decide how much you want, for what purpose you want, within how many years you can repay this, and how are you going to repay. please come with this information. You have to tell the customer. So this is customer management. You have to tell this customer. So this is borrowing proposition. Banker's responsibility. Banker, the bank manager, the credit officer, they have a responsibility. Bank is doing a business. Bank is doing a business. Yes, bank is a business organization. It is not a service. It is providing the service also, but it's not a Samuga Seva service. No. It should sustain its business operation. So when we do the business bank, we must sustain the operation. How can we sustain? What we lend, we must recover. Then only we can continue it. Then only we can continue our business. Bank should safeguard its funds and make a reasonable profit to sustain its lending operation. The banker to ensure as far as possible that borrower will repay the debt in full with interest within the scheduled time. So when the banker granting the facility, he must say to himself, he must ensure, I have done all the analysis and everything carefully and decided to grant this facility. I am granting this facility, so this customer will pay his loan plus the interest within the stipulated time, within the scheduled time. The banker to ensure as far as possible that the banker borrower will repay the debt in full with interest within the scheduled time. This is bank managers. Yes, you are going to do this business since you are working in the bank or finance company, and if you are handling this credit management, then you have to ensure yourself. This is your responsibility. This is your responsibility. Clear? This is your responsibility. Yes. Banker's decision on lending. Banker, yes. So for you to ensure granting the facility, you must decide. So decision-making process. You have to decide whether to grant this facility or not. Bankers reach lending decision very often based on experience. Based on experience. Yeah, certain feeling that the loan will be repaid in full. You are getting some interior feeling when you are doing the analysis, that, this, and everything. When you decide, yeah, there is some interior feeling. Based on your experience, you will get a certain feeling inside that this loan will be repaid in full. We call it intuition. We call it intuition. The managers or the credit officer will have an intuition that this loan will be repaid. Interiorly, yes, interior feeling you will get. But that is through your experience. But the experience should come from learning and applying the principles of good lending thoroughly. Sometime you would have seen your managers maybe used to say, some customer comes and have a discussion for a loan with him, and after going, he used to say, I am not going to grant this facility this person. මෙයාගේ මූණ හරි නෑ. මූණ දකිනකොට මම දෙන්න හිතන්නේ නෑ. Some managers used to say. So it is not on Muna Balala Navi. It's not that looking at the face, the interior feeling or the decision. Credit decision should not come from by looking at the looking at the face of the customer. No. But the experience should come from learning and applying the principles of good lending thoroughly. That way you must get the experience. Maybe the first loan, the first credit file given to you by your superior. Yes, the first one you are going in the credit management process you are going. It may take about 2 or 3 months. Yes. Now, because one by one you have to study, you must analyze, do everything. Sometimes it may get some longer periods. Maybe, yes, it may get about 2 or 3 months for you to decide to grant or not. Okay, thereby you are getting the experience. When the second loan comes, already you have experience. This is the second loan you are handling. Again, you are studying, analyzing, doing that one. This one you may do it in 1 month. When the third one comes, already you have experience by studying, analyzing, granting 2 loans. Now the third loan, you may be doing it in 3 weeks. Fourth loan, you may be doing in 2 weeks. Next loan, thereafter, in a 1 week time, you will, because you have a lot of experience now, going through these credit files and analyzing and making the decision you have. That of course come through the experience should come from learning and applying principles of good lending thoroughly. So now in the 5th loan, you have ample experience by handling some credit files before. So now you have experience. So when you go through it, and when the customer come for an interview, the way customer come, the way he sit, the way he talk to you, you will decide. That by the time you have gone through the file and analyze everything, and then and there you will decide. So within 1 week time, you will be able to decide whether this loan can be granted or not. So the experience should come through that way. The experience should come from that way by learning and applying the principle of good lending thoroughly. So as you all are going to be the credit specialist in future, some people may be handling now, some people have an idea of going for this one, becoming as a credit professionals. So this is an important advice to you all. Try to learn the good lending. Thoroughly you must learn and apply it in your day-to-day credit management activities. You must apply what you learn, the good lending, quality lending, bankers' decision on lending. Okay. So those are the basic things for a credit management professional, for them to know. So we have done. Now we will go to, there's another important aspect in credit, the culture. Your culture is a general term. Culture is a general term. So we look at it. Culture. What is culture? The sum of attitudes, ideas, customs, beliefs, values, and social behavior of a particular people or society that distinguishes from the others. So is applicable for a particular group of people or society. What is it? Their attitudes, their ideas, their custom, their beliefs, their values, and social behavior of a particular people or a society that distinguish from the others, other type of people or other society. So now, example, Sri Lankan culture. So our Sri Lankan culture will differ from the Indian culture. Both will differ from the Western culture. So we have different cultures. This is culture. We Sri Lankan will have attitudes, ideas, custom, beliefs, values, and social behavior, which is different from the Indian people or Westerners. So this is our Sri Lankan culture. Then it is transmitted from one generation to others through languages, material, rituals, arts, etc. But there is no written down books or anything. Yeah, you must do this about the culture. No, this is transmitted from one generation to other through the languages, material, ritual, art, the behavior. How? So I follow my father's. My father would have followed definitely his father, our grandparent, and my children will follow my culture. So similarly, each society, it is transmitted, the culture transmitted from generation to generation. It is going on. So one simple example, in Sri Lankan culture, the verse about is worshiping the parents. worshipping the parents. So this is there. The children are worshipping the parents. The parents had worshipped their parent. So this is going on by generation to generation. So this is the culture of a particular group of people or society. And so if you take a country, we all are having the Sri Lankan culture, which is our main culture. Which is our main culture. Sri Lankan culture. But within the Sri Lankan culture, there can be subcultures. There can be subcultures. Buddhist culture, Hindu culture, Christianity culture, Islam culture. These are subcultures. All together make the Sri Lankan culture. So this is a general term about the culture. We may know or we should know. So within the culture, there is main culture and the subcultures. Similarly, within the country, there are organizations. The organizations also will have organizational culture. So that is a mixed culture, definitely. In the organization, there are Buddhist culture people, Hindu culture people, Christianity culture people, Islamic culture people, which make the organizational culture. But one organization will differ from the other organization in culture also. So you may see certain organization, when you go there, the way of their behavior, their dresses and everything differ from the another organization. The way of conversation, everything differ from. That is this culture and that is another organizational culture. So within the culture, organizations also will have their culture based on their ideas, custom, beliefs, values and behavior. The one organization differ from another organization in their culture. We call it organizational culture. Organizational culture. So, from where this organizational culture developed? From where this organizational culture developed? If you look at the organizations, if you look at their annual reports, organization, they have vision, mission statement. Mainly in their first page, you can see their vision and mission statement. There you can have their values. So values mean what are the things they are respecting, what are the things they are performing, values of that organization. Values of the organization. Actually, the organizational culture is developing and coming from the values of the organization, which they value. What are the things? Respecting our customers. We attend to them immediately. Like that, they have their values. Each organization will have their values. So these cultures developing from those values. And when in an organization, these values are clearly written. And if all the members of that organization know their values, and if they follow those values, then that organization will have a strong culture. We call it a strong culture. But whereas in an organization where the members of that organization do not know much about their values, and if they don't follow those values, then that organization will have weak organizational culture. So depending on that one, certain organizations will have strong organizational culture, certain organizations may have weak organizational culture. Strong organizational culture, whereas employees of that organization know their values and they respect that one and they follow those values, where that organization will have a strong organizational culture. On the other hand, where the employees of the organization do not know much about their values and they don't follow those values, they have a weak organizational culture. The organization which has strong organizational culture will do very well in their business. The organization which have weak organizational culture can't do very well. They will be weak in their activities also. So we must know the particular organization, whether it has a strong organizational culture or they have a weak organizational culture. So this culture, information about this culture is general. For the countries, for the organization, it's a generally we are looking at that. Now we come to, from this organizational culture, if the organization is a credit organization, credit-oriented organization culture, credit-oriented organization, then we have credit culture of the organization. So now we are looking at very, very important thing, credit culture of the organization. What is credit culture? What is credit culture? A bank's credit culture is the unique combination of policies, credit policies, practices, credit practices, experience, and management attitudes that define the lending environment and determines lending behavior acceptable to the bank. That is the credit culture. If all the employees are following this credit culture, then that organization will have a strong credit culture organization. Otherwise, it is a weak credit culture organization. The credit institution which has a strong credit culture will do very well. Whereas the weak organization which has a weak credit culture can't do much. So more broadly, credit culture is the system of behaviors, beliefs, philosophy, thought, style, and expression relating to the management of credit function. So it is related to the credit function. That is the behavior, beliefs, philosophy, thought, style, and expression relating to the management of the credit function. Now, based on that one, the participant, you can decide whether your organization is having a strong credit culture or a weak credit culture. If your organization is having a strong credit culture, your organization is do very well in the banking area, in the credit function, they do very well. Otherwise, your organization will be weak. And the importance of this credit culture, the importance of credit culture was emphasized under Basel II, now under Basel III, but it is already stressed, emphasized under Basel II. You may learn later about the Basel, but now you know the credit culture also considered very important, considered as very important for better performance of the credit function of a lending institution. And they should have a strong credit culture. They will develop. Who is responsible to develop a credit culture in their organization? Next question. Who is responsible to do or to develop a credit culture in their organization? Actually, it should be the top. And it should develop and it should come down. Should come down to the other employees. It should come. The credit culture concept and the details should develop at the top, and we call it top-down process. The credit culture should be a top-down process. But whereas an institution where the top is not taking concern about the credit culture, actually the credit culture, in those cases, it will develop at the bottom itself. And it may go little by little above, bottom-up process. When the top is not interested developing a credit culture, strong credit culture in the organization, actually it has to be done by the top. And then it should come down, top-down process, the credit culture. If it is not done, the credit culture will be developed at the bottom itself on its own. And it will come up. bottom-up process, which is going to be very weak. So when a institution, credit institution is having a strong credit culture, what happened? It will create confidence. When an institution having a strong credit culture, it will create confidence among its employees, among other stakeholders, and the general public. It will create a confidence, and they will have a faith and trust in that organization. So for that purpose, for that important, all institutions should have a strong credit culture. They must develop a strong credit culture within their organization. Then, as I mentioned now, the employees of the institution, all the stakeholders, especially the shareholders and the general public, everybody will have a trust and faith in the organization. If it is so, then the organization will do very well. This is credit culture. Now, next one, we move on to another important area, importance of risk assessment in credit proposals and mitigation. Really, this is importance of risk assessment in credit proposal, and mitigation. How can we reduce it? Actually, a financial institution is facing so many risks. A financial institution is facing so many risks. Some risks we have earlier seen in our first lesson. You would have seen that asset and liability management. We have seen between the asset and liability of a financial institution, there may be matching. There may be matching between the assets and liability of the lending institution, financial institution. If it is not matching, then if there is mismatch, then there will be risk. If there is mismatch, one is, we have explained, credit risk because of the default, interest rate risk because of not matching the interest rate of deposits and the loans. Similarly, we have seen maturity risk, foreign exchange risk, certain risks we have seen in our previous lecture. Once again, credit risk, interest rate risk, maturity risk, foreign exchange risk, which all I have explained. You must understand now. So these are certain risks. And there are some additional risks also. Legal risk, some market risk, reputation risk. So there are so many risks the financial institution is facing. Because of the risk, the institution may face losses. Because of these various risks, the institution may face losses. Actually, there is a separate lecture, maybe later, about the risk and risk management of the financial institution. Some lecturer will do that one. So I am not doing that one. The risk management, no, I am not doing this one. But in the case of credit risk, if you look at the credit risk really starts from the credit proposal itself, from the loan application of the customer. And the credit analysis, we must find out what are the risks. Because of that one, the risk assessment in credit proposal, which only I am going to do now. Apart from that, overall risk management, which I have mentioned now, credit risk, interest rate risk, then maturity risk, and then foreign exchange risk, legal risk, market risk, then reputation risk. All these things will be done by a separate lecturer later in a separate lecture. I am going to do now only in the case of credit. In the case of credit, the risk is really start from the very beginning. From the customer's application itself, the risk is coming up. So a credit officer should identify what are the risks and how can we reduce it, mitigate in the credit proposal. That's what I am going to do now. Okay, right. So you shouldn't get confused. You will learn about the risk later. Right. Now we define the risk. What is risk? Any activity in our life involves risk. Yeah, yes. Sometimes when I am walking, I may get, I had a fall. I may have a fall. I may fall down. So, any activity in our life involves risk. Risk do not disappear. Risk is there. They give users a choice, which to retain, which to shed. So users know, which to retain or which to shed. What we have to live, what we have to risk, we have to face. No risk, no gain. If there is no risk, no gain. So if you face the risk, you may get a gain sometime, or you may lose also. So this is basically risk. General definition of risk. The probability of unexpected happening. Unexpected happening. But we know there is risk, but unexpectedly it may happen to be. The probability of suffering and loss. Probability of suffering and loss. So it is a measure of the probability and the consequence of not achieving a defined goal. That is a general definition of risk. So risk means it is rare, unexpected, incident, RI, incident, that is outcome. So risk RI means rare, unexpected incident, outcome. Yes, so what you have to do, you must select. You must identify the risk. You must identify the risk. And K, R-I-S-K, knock the risk, knocking. How you are knocking? Identify, after identifying, measure what will happen. If it happened, what happened? So to reduce that one, monitoring, you monitor, you control. That is the risk. So if you total it up, unexpected outcome, so you must identify it, you must measure it, and then to control it, monitoring and controlling. That is risk. Risk involves two concepts. So risk can be there. It may involve two concepts. One is likelihood that problematical event will occur. Some unexpected event may occur. Likelihood that some problematical event will occur. If it occurs, the impact of the event, if it does occur. So if it occurs, what will happen? If it occurs, what will happen? Again, the risk is a joint function of two things, two elements. The risk is a function of likelihood of that risk occur, and if it occur, the impact. So risk should be assessed qualitatively and quantitatively. Qualitatively means whether it will occur, what percentage, what probability if it occur. If it occur, what is the outcome? Quantitative. So risk, of course, you have to analyze qualitatively and quantitatively. Whether it will occur, to what percentage it will occur. If it occur, what is the quantitatively, what will happen. So this is a very basic thing. Other elements of risk. Okay, before that I will give you some example. When we taking our vehicle to pump petrol in a service station, there you can see some there or some notices. Before putting the petrol, stop the engine, don't smoke, don't use the mobile phone. Don't use the mobile phone. Switch off your mobile phone. Most of the petrol stations you can see. Switch off the engine, do not smoke, and then don't use the mobile phone. What is that? These three things, one is smoking, and other one is running the engine, other one is using the mobile phone. This can cause fire hazard. This can cause fire. Because in a petrol station, when they pump, this petroleum is easily vaporizing. So the petroleum vapor is there. In the surrounding of a petrol shed, there is petroleum vapor. Because one pumping, you can see, you will get a smell, no? So it is vaporizing. Yeah. When you smoke, the petroleum vapor can catch fire easily. Fire hazard. There is a big problem, danger. The entire petrol set may get fire. That is one. Engine. If the engine is working, engine will get heated. So the heat will come. With the heat, if the concentration of the petroleum vapor is high, it may get fire. Again, fire hazard. When you are using mobile phone, your mobile phone battery may get heated. Sometimes it may burst also. From there, again, petroleum vapor, it may get fire hazard. So we cause of the risk, the risk factors. Risk factors. What are the risk factors? Smoking is a risk factor, and running engine is a risk factor, and operating a mobile phone is a risk factor in a petroleum station because of the petroleum vapor. So something or lack of something can induce a risky situation. So these things we call it the source of danger. These are the risk factors we call hazard. These hazards are the risk factors in a petroleum station. These are the risk factors which can pose risk of fire. Risk of fire. So India petrol station may get destroyed. So this is hazards. On the other hand, another one. While running the motorcycle, you are requested to wear your helmet. Because the brain is the most delicate organ in a human body. Brain is the most delicate organ. If you meet with an accident, if your head is affected, you may die. So just to prevent that one, you are advised to wear the helmet. So here, it is preventing the danger. It is preventing the or reducing the danger. Wearing helmet while motorcycle riding. Similarly, while driving a car, you are requested to put the seat belt. When you meet with an accident, your heart may get affected, chest may get affected, you may die. But putting the belt, that will be prevented. So that is also reducing or preventing the risk of your death. So there are two factors. One is hazard, which are causing the risk. So these are risk factors causing the risk. In a petrol station, these are the hazard, risk factors causing the fire hazard, fire risk. Other one, wearing the helmet or we are putting that seat belt is preventing the risk. So two things. So risk is a function of hazard, which is causing the risk, and safeguard, which is preventing the risk. So these two things, these are generally about the risk. You must understand certain things. Because of that one, I am explaining this. We are talking about risk. Risk is everywhere. Even in the medicine, yeah, heart failure, heart attack. It's a risky situation. It's a danger. There may be so many risk factors. Overweight, cigarette smoking, lack of exercise, eating heavily. These are the risk factors which can cause a heart attack and which can finally cause a death. The human medicine, everywhere, building, everywhere you can see the risk. So this is generally we are seeing there are two things. So to preventing the heart attack, there are safeguards. They are saying you take regular exercise, less eat less small amount or less oily food. take medicines carefully. So these are the safeguards to prevent the heart attack. So there are hazard or risk factors causing the heart attack. There are safeguards which is preventing the heart attack. So similarly, everywhere the risk is there, the risk causing factors are there, risk preventing factors also there. So we must know. So in banking, in credit disbursement, in credit granting, credit facilities, also there are risk of credit default. Credit default is a yes. And because of that one, bank will have losses. Ultimately, bank will have losses. So what are the hazard causing the credit risk? What are the safeguards which can use it to prevent the credit risk? That's what, because of that one only I have explained all these things. So in a risky situation, there are two elements. One is hazard, that is risk factors, which causes the risk of credit default in our credit function. And other thing, safeguards, which are preventing the credit risk. So good risk management should identify hazard. What are the hazard in our credit proposal? What are the risk factors which can cause default in our credit proposal? You must identify. Similarly, what are the safeguards we can provide to prevent the credit default? So, good risk management. So, when you are doing risk management in a proper way, good risk management, you should identify the hazard and to allow safeguards to be developed to overcome them. So, it is starting from the credit proposal itself. Credit application proposal you are analyzing. When you are analyzing the credit proposal given by the customer, you must look at whether there are risk elements, whether there are risk factors which can cause default, where are any safeguard, whether we can provide to control the risk, that is credit risk, credit default. So these things you have to start from the credit proposal itself. And from the credit proposal, then implementation, thereby risk factors will be there continuously till the repayment. So if there are enough safeguards, risk can be reduced to acceptable limit. So you must find out the hazard, which that means the risky factors which can cause default risk, and you must see what are the safeguards you can provide to control this risk. So this is, so now overall risk function of its component. So now in this graph you can see low risk area. This is the graph plotted probability of loss against the magnitude of impact. Probability of loss against the magnitude of impact. The graph is plotted. So there is low risk area, then there is moderate risk area, then there is high risk area. In the case of low risk, yes, you can go on lending. The collateral, depending on the one, you can take the suitable collateral. In the moderate risk area, risk is little high. Even here, you can go for lending, where you can increase the collateral requirement, security requirement, you can increase. High risk area, yes, where of course it is very high, you are sure that there will be default is definite, so you just not to handle that type of facilities, high risk facilities, not to handle. Even very high, very good quality, security or collateral also given, but you are sure they won't be able to pay back. When the repayment capacity is not there, when the repayment is very doubtful, Even whatever the security is given, not to accept it. So lower risk one, moderate risk one, you can go ahead. So overall risk function of its component, that is this. So now creditworthiness versus credit risk. Creditworthiness versus risk. So there are two things. One is credit risk, where credit risk is low, and other side credit risk is high. When the credit risk is low, creditworthiness is high. When the credit risk is high, creditworthiness is low. So we are relating this one, creditworthiness to credit risk. When you say creditworthiness, if the creditworthiness is high, that means credit risk is low. When the creditworthiness is low, that means credit risk is high. So creditworthiness is related to credit risk. Creditworthiness is related to credit risk. Once again, if the creditworthiness is high, mean the credit risk is low. If the creditworthiness is low, mean credit risk is high. So credit analysis is really risk analysis. When we do a credit analysis in the credit proposal, when the customer is giving a credit application, when you are doing the analysis, appraisal, you are really appraising the risk, whether there are any risk. So credit analysis is really risk analysis. Really risk analysis. So you must relate creditworthiness is credit risk analysis. Management of credit risk. So in the credit proposal, when you are analyzing the credit proposal, appraising it, assessment of credit risk, you must assess the credit risk or with the credit risk in the credit proposal. That means identifying the hazards and identify lack of safeguards. If there is lack of safeguards also, that will cause credit risk. So identify the hazard, which can obviously create credit risk, and lack of safeguards that also can cause us credit risk. So you must assess. So when you are going through the credit proposal, appraising, analyzing, or evaluating, you must assess the credit risk in that proposal. Then you must see how can you mitigate or how can you reduce the credit risk. So credit risk will be there. That means there are certain thing, credit factors can cause risk of default. It may be there. It may be there. I just, if you look at yes, there is risk, then you won't be able to grant the facility. Make a buy one or make a risk. These are the risks. Then you won't be able to grant the facility. I generally use example. Malu kama, fish curry is tasty, but in certain fish there is katu, bones are there. So sometimes it may hiravenama, ugure. That's risky. Then you have to be taken to the hospital, consult the doctor, removing the bone, that one, this one, everything. Those are the risky situation, risky, because of the fish curry. So if you are bayavenuvanang ekata fish kama kandamama, you won't be able to eat fish curry. But what a tasty food. So what you have to do, yes, you know there is risk of bones. There is a risk of bone. Katu tiyanava, katu hiravenda puluvan ukure. A risky situation. So what you have to do? One thing, either you should not eat fish curry, or yes, eat fish curry very carefully. Removing the cut, removing the bones, cut to evaing karla. Parisaming kamagato, eka rasa kama, kanda puluang. You can have a very tasty fish curry food. Similarly, in the bank also, there is a credit default. That credit factors are there, default or risk factors are there that may cause the risk of credit default. ඒකට බය වෙනවා නම් ණයම දෙන්නම බෑ. බැංගු බ්‍රාන්ච් එකේ නිකන් වාඩි වෙලා මැනේජර් ක්‍රෙඩිට් ඔෆිසර් වාඩි වෙලා මූණ බලාගෙන ඉන්න විතරයි තියෙන්නේ. You won't be able to grant. ඒකට බය වෙනවා නම්, but we are the credit institution, we are there to give. So what we had to do, we must identify. The risk elements are there in the proposal. You identify, measure, if it happened, yes, it may cause the default. So how can we reduce it? What are the safeguards? You have to provide various safeguards to reduce or mitigate the risk, and then grant the facility. And thereafter monitor closely, follow up closely, because the risk you have already identified. Based on the risky situation, you must provide safeguard, and then you have to do follow-up, monitoring carefully, and recover it. You can reduce the credit default. නැතුව credit risk තියනවා කියලා බය වෙනවා නම් ණයම දෙන්න බෑ. බැංකුවට ආදායම් මාර්ගය නැහැ. Definitely. I have already told risk is there everywhere. So in the banking institution also, in lending, risk is there. So identifying the hazards and lack of safeguards, then only assessing the credit risk. Then what you mitigate or reducing the risk of credit risk. Reducing the credit risk. What you have to do? Reducing the hazard. What are the factors? How can you reduce the hazards in the credit proposal? How can you reduce the hazards in the credit proposal? Then, how can you increase the safeguards to reduce the hazard? How can you increase the safeguards? So these are two important things in a credit proposal. When you are evaluating or when you are appraising, you must look for the hazard, prevent the hazard, weigh and mean. How can you reduce the hazard, prevent the hazard, and similarly, how can you provide safeguards? These are the important things when you are doing, analyzing, appraising a credit proposal. So reducing the hazard, increasing the safeguard, then cushioning the risk through collateral. Even after this, if there is a risk element, cushion the risk through collateral, provide the collateral. So this is what you have to do in the appraisal technique. This has to do what you must do when you are evaluating the credit proposals. So the risk is starting from the very beginning. Risk management is starting from the very beginning, from the credit proposal. Then controlling and monitoring the credit risk. Thereafter, how can you control and monitor? So I have told you risk, R-I-S-K, risk, unnecessary thing, identify it and control and monitor it. So here, identify the risk and then provide safeguard, reduce the hazard, provide safeguard, and then control and monitoring the credit risk by follow-up and supervision. Very important. Depending on the risky situation, you have to enhance the follow-up and supervision. You have to. So there is a relationship. You have to do it. If the risk element is there, if you identify here, this is risky, you are cushioning through, you are providing the safeguard, you are providing, reducing the hazard, you are providing the safeguard and cushioning through the collateral, and even thereafter, follow up and supervision. Follow up and supervision. So the follow up and supervision, there may be two: pre-sanction, before granting the loan, that is pre-sanction, and after granting, post-sanction. Pre and post sanction, supervision, and follow up. You have to do it. So all these are to reduce the risk of default. We are doing all these things to reduce the risk of default. And then calling report. There is another way. Periodical. If the risky situation, call periodical reports, financial performance report from the customer. So you call and analyze and see whether it is going on as planned. Then attending the meeting, yes, they may have their board meeting as an observer, you can attend. They can have their management meeting, you can attend the meeting as an observer, what they are discussing. If that is the situation is there, if you think, yeah, this has to be done, then you have to attending the meeting and inspection, periodical inspection. If the risky situation is low, you can reduce all these things. You can reduce the inspection. You can reduce the number of inspection. If the risky situation is high, you enhance, increase the inspection, periodical inspection. So these are at the branch level. Then management of the credit portfolio, looking for non-performing advances, NPA. That is also at the branch level, maybe at the district level, maybe at the provincial level, and in the national level, you have to. All these things, the management of credit risk. So from the branch itself, from the credit proposal itself, the credit risk is going on. So you must understand and try to prevent the credit, reduce the credit risk from the credit proposal itself, and state by state credit proposal, then the branch level, then the district level, province level, and finally the national level. You must reduce, manage the credit portfolio and manage the credit risk. This is the management of credit risk. Okay. Now the time is 10:20. We will have a break. We will meet by 10:30. Okay. Okay. We meet by 10:35. We meet by 10:30. Please come by 10:35. We are going to do some important thing in the credit management, some important subject we are going to discuss. So we meet by 10:35. Thank you. Now we can start again. Before that, I just want to find out whether my voice is clear to you all. Hello, participants.
Yes.
Whether my voice is clear to you all?
Yes.
Yes, sir. Yes.
Yes.
It is clear, right?
Yes. Yes.
Okay, no problem. Any problem you have?
No.
No. Okay, fine. Let us continue. Right. Thank you. Thank you very much. Thank you.
Okay.
So we have, okay, right. So we have completed management of credit risk. So once again, I want to say the credit risk analysis starts from the credit proposal itself. So when the customer gives the application, there itself you must assess the credit risk. Okay, fine. Now we go to another important area, types of credit facilities and advances. So what are the type of credit facilities we are granting to our customers? So it is very, very important to you all. You must know what are the various types of credit facilities. Type of credit facilities and advances. So we can categorize this one into direct advances or facilities and indirect advances and direct advances and facilities, indirect advances and facilities. So what is the meaning of direct advances and facilities? It is fund-based. The fund is going from the bank to the customer. So fund-based advances and facilities, we call it direct advances. When a customer wants 10 million rupees loan, so 10 million is going from the bank to the customer, fund-based. Since the fund is going from the bank to the customer, bank is charging interest income. So it is interest income, fund-based interest income. And this type of advances are coming in the balance sheet as assets, which we have learned in our last lecture, assets, bank funding. Fund-based and interest income, it is stated in the bank balance sheet as assets. Then since the fund is going from the bank to the customer, bank cash flow is get affected. The cash flow is going out. Cash flow, it is outflow. So it will affect, since the cash in hand is going down, it is affecting the liquidity of the bank, because liquidity will be reduced since the fund is going out. So liquidity or the cash flow of the lending institution when the facility is granted. So this type of facilities are called as direct advances and facilities. We will see what are the examples later. We will see what are the examples. So one type of credit facilities, that is direct advances and facilities, which means those are fund-based. Since the fund-based, fund is going out from the bank, interest income and balance sheet item as assets, And then since the fund is going out from the bank, it affects the liquidity or cash flow of the lending institution when the facility is granted. So these are direct advances. Then the other type, indirect advances or facilities. Non-fund based. Fund is not going from the bank to the customer, but the facility is granted. That is indirect advances or facility. Indirect advance or facility is granted, but the fund is not going from the bank to the customer. Since the fund is not going from the bank to the customer, bank won't charge interest, but bank charge a fee. A charge is made. Fee, we call fee. So it is fee-based income. In this case, indirect advances or facilities, it is fee-based income. And then, since the fund is not going out of the bank, it won't be mentioned in the, it won't come in the balance sheet. But in the balance sheet, it is mentioned as a note. So we call it off balance sheet item. Off balance sheet item, and it is called as contingent liability. Contingent liability. We will see the meaning of contingent liability little later. I will explain to you. But now you note it. It is a contingent liability. These indirect advances or facilities are contingent liability, and these are off balance sheet item. Since the fund is not going out of the bank to the customer, do not affect liquidity or the cash flow of the lending institution when the facility is granted. Facility is granted, but it's not going from the bank to the customer, so it won't affect the liquidity or the cash flow of the lending institution when the fund facility is granted. So these are two main types of advances or credit facility. One is direct advances or facilities, other one indirect advances or facilities. Okay, now we move on. Direct advances. Examples: loans, overdrafts, line of credit, cash credit. Cash credit is like an overdraft. Actually, in India, they use this term cash credit. For business customers, they give the cash credit. That is similar to overdraft. In India, they call it as business customers, the overdraft facilities called as cash credit. So for just to know, we have put that one. Then bill discounting, we will explain it later. Then the revolving credit, that is credit cards, financing credit cards. So these are the example for direct advances. Once again, loans, overdrafts, line of credit or cash credit, bill discounting, and revolving credit. Direct advance. We first, of course, see this direct advances. Loans. So what are loans? Granted on application after careful credit evaluation. So customer has to make an application, and the bank officer, after careful credit evaluation, if it is acceptable, they will grant the facility. There is a loan limit. Maybe 5 million loan or 10 million loan, the loan limit. That within the limit will be released. Then terms and conditions or covenants applicable. There are terms and conditions are applicable for these credit facilities. 11 terms and conditions will be there for the credit, these loan facilities. Generally secured. Generally secured. That is, the bank will obtain collaterals for the loans. Collateral for the loans. There are various types of collateral. Yes. But sometimes, for a best customer, bank grant the facility without taking any collaterals. We call it clean facility. Clean facility. Best customers, bank can grant the facility without collateral. We call it clean facility. When the facility is granted with mortgage of assets, then we call secured facility. We call it secured facility when the facility is granted with mortgages. Otherwise, not secured, unsecured facility. Then there is a definite reduction or repayment program for these facilities. When you are granting the loan, there is a definite repayment or reduction program. There is another term used, loan amortization. Loan amortization. So there is a definite reduction or repayment program. Because of this definite reduction or repayment program, there is another term for this loan, installment credit. These are installment credit. So these are the general features of loans. Once again, granted on application after credit evaluation, then there is a loan limit, maybe 10 million loan or 5 million or 50 million loan. That amount will be released, maybe advance or stages it will be released. Then there are applicable terms and conditions and covenants for the loan. Generally secured, the bank may take security or collaterals. Then there is definite reduction or repayment program that we call it loan amortization, and this type of loan we call it installment credit. In the overdraft, this also in the direct advances or facility overdrafts. There are two types of mainly permanent or temporary overdrafts, and these overdrafts are allowed in the current accounts. So it is granted to the current account holders. The financial institution banks current account holders. To them only the permanent or temporary overdrafts are granted. These are granted on application after careful evaluation. So customer has to make an application. After evaluation only this will be granted. Then OD limit. There is an OD limit. And since the OD is granted to the current account, their balance fluctuates within the limit. So the manager will mark the OD limit in their current account. Maybe if it is a 2 million OD limit, so he will mark it 2 million. And the period. So the balance will fluctuate. Actually, what will happen? The customer will take the money and then he will put the money. So it is revolving within the limit. Within the limit of the OD limit, the customer can withdraw the money and he can credit the money. He can put the money. He can withdraw and he can credit the money. So it is revolving for the period allocated. If the period is given for maybe 2 months or 3 months, up to that period, the customer can take and credit the money, take and it is revolving within that limit, OD limit. Balance fluctuate within that. Then there is terms and conditions for this facility also. Interest term, within what period it has to be settled, terms and conditions and everything with the covenants, for this overdraft facilities also. Terms and conditions, covenant. Generally secured, that is generally secured, the bank may take the collateral for these facilities also. Overdraft facilities also, bank may take the securities or collateral. And POD, that is a permanent overdraft facilities. Permanent overdraft facilities. That is permanently the facility is granted, generally to meet the working capital requirement. For the business customers, this is granted to meet the working capital requirement because working capital is revolving within the business. Working capital or operating capital, this is working within the business. So to match that one, the PODs are granted. So when capital, they may take and they may take the money, credit money. It is going on. So it is POD generally to meet the working capital requirement. With or without definite repayment program. So sometimes these permanent ODs are granted, maybe for 1 year, or maybe for 2 years like that, or maybe till the business is going on permanent without definite repayment program. If the overdraft is permanent overdraft is given for 5 years, then of course definite repayment program. Annually, the overdraft limit will be reduced. The first year it will be reduced, then second year further reduced, third year further reduced, fourth year further reduced, fifth year completely, then it is reduced and fully settled. That is POD. And certain cases, it is without no repayment program. As long as the business is going on, they can have this facility. Customer can enjoy this permanent overdraft facility to match their working capital requirement. But in the case of permanent overdraft without the repayment program, without the repayment period, then it will be reviewed periodically. It will be reviewed periodically. Even with the repayment program, also if it is repayment is for 5 years, then annually the overdraft facility will be reviewed. What is the meaning of review? The review, that means whether they can allow the facility to continue, whether they can. So for that purpose, again they will appraise and evaluate and see whether it is going on, whether there is revolving, whether the amount is withdrawn, amount is credited, withdrawn, credited, withdrawn, credited, it is revolving. In some cases, if they are withdrawn, it has come to the limit, thereafter no revolving for some period. That means actually expected the working capital, customer could credit the money and withdraw, it should go on. It should go on. So when there is no proper revolving, only interest is added to the capital, then we call it hardcore, HARDCORE, hardcore overdraft. That is, the overdraft is not operating. Overdraft is not operating, not revolving. In that case, we call it hardcore overdraft.
Change your portion is weak and presentation portion is now it's okay. Thank you.
Okay. Yeah. So we had to deal with the technology. Right. So POD, permanent overdraft, generally to meet working capital requirement with or without definite repayment program. So whatever it is, it will be reviewed periodically. With repayment program or without repayment program, if the repayment is more than 1 year, then it will be reviewed periodically. And in the case, and actually it should revolve. Revolve. That is, the customer takes the money, withdraw the money, and then he has to credit the money. So it will revolve. In some cases, if it is no proper revolving, only interest is charged, then for some time, that is, it is not operating. The permanent overdraft is not operating as anticipated. We call it as hardcore, and bank may demand the repayment. And the overdraft facilities are always on demand. It has to be on demand. It has to be repaid. Then TODs, that mean temporary overdrafts, are short term to be settled within the specified period, maximum 3 months. So temporary overdrafts are granted to customers, their best customers, maximum repayment period, that is short term, within 3 months. So sometime it may be 1 month period, or sometime 2 months, maximum 3 months period. These are high risk advances. There is another type of overdraft facilities. We call it casual overdrafts. The meaning is, now a customer, good customer. He is having a very good relationship with the bank, no problem for the bank. But one day his check has come for payment, a cross check has come for payment, but there is no sufficient funds in the account. The manager, what he has to do, he has to return the check. But since he is a good customer, manager may pass the check, giving temporary overdraft. Without, actually in the case of temporary overdraft, customer has to make a request. But here customer didn't make any request, but the manager thinks, yes, there is short of funds. But anyway, customer is good, so pass the check by giving a short-term, overdraft, and pass the check. And then telephone the customer and tell, please look here, there's a check for this amount. Anyway, there is insufficient fund. I have passed the check, please come and deposit the sufficient amount. Okay, so that type of overdrafts are called as casual overdrafts. So these are the overdrafts. These are the overdrafts in the type of direct credit facilities. Then the bill discounting. This is another direct credit facilities. Bill discount. Check purchasing and discounting. Check purchasing and discounting. Check purchasing. So I can give you an example. I get a check from a person. Maybe it's a check, it's a People's Bank check from Matara branch. Maybe about 500,000 rupees. As an example, I didn't get any check like that, but just an example I am telling you. So there's a check from Matara People's Bank check for the amount 500,000. Today's date, today is say 23rd. Yes, 23rd. Okay, but it's a cross check. Then what I have to do is I have to go and deposit the check to my account. Then I may get the money tomorrow evening, or maybe day after. I will get the money. It has to be get cleared and then come. Then only my account will be credited. But I need the money today. I need the money. So I am a good customer of my bank. I go to the manager. Could you please purchase this check? The check is, so manager is looking at, yeah, this is dated today. So today dated, so he can purchase it. So he says, okay, I am a good customer of the branch. I don't have any black mark or anything. Manager may know I am a good customer. So okay, right, we can purchase it. So he will give me, he will ask me to fill the check deposit slip and giving all the details and make a request to purchase this check. So I will write, kindly purchase this check. Then manager will purchase the check and give an immediate credit for that amount. 500,000 check. Then of course he will give me 500,000 credit to my account. And then he will send the check for the collection. Once the payment is coming, my account will be credited. For check purchasing, the bank will charge a commission. Bank will charge a commission based on the number of days. That is today's check. So he will charge a commission for that period. This commission will be equal to the interest rate for that amount, almost equal to the interest chargeable for that amount 500,000. So this type of facility is called as check purchasing facility. Unfortunately, if the check is returned without fund, then the manager will ask me to deposit that amount. The manager will ask me to deposit that amount. If the check is passed, get cleared, then no problem. Yes. Otherwise, I had to go and deposit that amount to my account. This facility is called as check purchasing. So purchasing the check, so today's dated check, they will purchase it today. That is check purchasing. Check is post dated. That also the bank can. Similar way, the bank can, yes. That we call it bill finance, discounting the check. So one is check purchasing. If the check is dated today, it's check purchasing. The check discounting, if it is a post-dated check, the bank can. And charge the commission based on the number of days and the amount of the check. Based on the number of days and the amount. Based on that one, they charge a commission it is almost equal to the interest payable for that amount for those number of days. This is discounting. Both type of facilities are there. But some bank, they don't do check discounting. Only certain banks are doing check discounting because it is high risky. Sometimes the check is returned and if the person is not crediting, then it's a problem. But almost all banks are commercial banks. These are doing by commercial bank only. They are only you can have the current account wherever the current account only they are doing it. So check purchasing facilities granted by almost all commercial banks. But only few commercial banks are doing check discounting facility. They are extending to the managers. So this is check purchasing and discounting. Then bill discounting or bill financing. Bill discounting or bill financing. These are financing post-sale operations. Post-sale, after-sale operations, for the purpose of financing post-sale operation, the banks are doing bill discounting and bill financing. This is very famous in the international trade bill. So it is under letter of credit or under documentary collection. This facility is extended by the banks to their customers. Now what I am going to say is, now after this program, you will be having this international program. There, the lecturer will explain to you about the import and export and these letter of credit facilities and other things. So after that, I will explain you the bill discounting or bill financing under letter of credit or under documentary collection. Now, because if I explain you now, some people may not understand. Without the knowledge of letter of credit operation or documentary collection operation, without that one, you won't be able to understand that this clearly. So I will explain to you after international trade program, I will explain to you this one. Similarly, inland bills also, I will explain to you later. So this portion, I will explain to you after you do your international trade module. Indirect advances. Indirect advances. So now we have completed direct advances. Now this is indirect advances. What are these indirect advances? Where bank funds are not going from the bank to the customer, but the facility is granted, credit is granted, facility is granted, but the bank funds are not going to the customer. Since the bank funds are not going, bank is not charging any interest, but bank is charging a fee. The example, bank guarantees and bank bonds. These bank bonds, these bonds are different from the central bank bond, government bond. No. Don't, yeah. This is bank guarantee bond. This is bank guarantees and bank guarantee bonds. That the name bonds indicate the bank guarantees. So indirect advances, the example, bank guarantees and bank bonds. These are contingent liabilities for the banks. What is the meaning of contingent liabilities? At the time the bank is granting this facility, no, it is not a liability to the bank. It is not a liability to the bank. But if the customer default this facility, the customer default this facility, then this will become as a liability to the bank. Then this will become as a liability to the bank. So that's what we call it contingent. That is potential and possible obligation. That's what the contingent means. This facility can become as the potential and possible obligation of the bank to pay somebody. Contingent liabilities for the bank. Then, since the fund is not going out from the bank at the time of granting the facility, this is off-balance sheet item. This is off-balance sheet item. Now, I am asking you, there's a small exercise. What are the accounting entries for this type of bank guarantees? If the bank is granting the guarantees, what are the accounting entries you are making. And when the bank settles the guarantees, when the customer settles the guarantees, how do you account entries to make? If the customer default, what are the accounting entries you will make? This is a small exercise for you all. I will ask you name by name in the next program. This is a small exercise. You had to find out from managers or your bank other officers what are the accounting entries when the bank is granting a bank guarantee to a customer. And when the customer repay, how you will handle these accounting entries. If the customer default, what are the accounting entries you will make? This is a small exercise. You have to do it. Next class, I will ask you name by name. So this is contingent liability. Now, as an example, yes, before that, I will explain bank guarantees and bonds. So here, example of indirect advances, bank guarantees and bank bonds. This is a contingent liability for the bank. I told you what is the meaning of contingent liability. At the time of granting, it is not a liability to the bank, right? But it is a potential or possible obligation whenever it can be. That is, if the customer default, it will become as a liability to the bank. The customer to whom this facility is granted, if he defaults, then it will be a liability to the bank, because at that one we call it contingent, possible and potential obligation. That is the meaning of contingent liability, potential and possible obligation. So this is an off-balance sheet items. In the fund is not going out. It's an off, that is in the balance sheet, and entries made, note is made about this facility. And the accounting entries you have to find out and you have to let me know. Yes, in the next class you must. Bank guarantee. What is bank guarantee? It is an irrevocable obligation of a bank. Irrevocable, not a revocable. Once you give, it is irrevocable. You cannot withdraw. So it is an irrevocable obligation of a bank to pay a specified amount of money if the applicant on behalf of whom the bank is giving the guarantee does not fulfill its contractual obligation. So I will explain. Now you please, I am going to use the board. So please kindly expand the whiteboard. You can see that one. I want to go to the board and I want to explain it. Okay. Right. So there is 3 parties about the bank guarantees. I am going to explain. 3 parties. One is bank, and then the customer, that is applicant, when there is another business organization, that is beneficiary. There are 3 parties. In a bank guarantee, there are 3 parties. So this customer, the applicant, is a now Highland milk dealer. Highland, by the Milko, they are producing Highland milk. They are distributing all over Sri Lanka through their dealers or agents, right? So dealer. So he asked Highland milk company, that is Milko, for a month I can sell 1 million rupees of Highland milk powder. Will you give me on credit? That is, you give me on credit, I will take it. On your credit terms, you give me this 1 million worth of milk powder. I will take it, I will sell, and I will pay you. Okay. Then the Highland may tell, okay, we will give you 1 million rupees worth of milk powder, maybe every month, right? Maybe every month. You sell and you can pay us, but you bring a bank guarantee for this value. You bring a bank guarantee for this value. Then we will give you under our terms and conditions, our credit terms and conditions. So each organization will have their credit terms and conditions. What is the maximum amount? What period? The customer, they can give the credit for them to take it and sell and pay back. Credit terms. Then beneficiary, that is Highland Milk Company, has told the customer, yes. Then the customer has to obtain a bank guarantee in order to get the milk powder from the Highland, sell and pay them back. So he is coming to his bank. He is coming to this bank and tell the bank, look here, I have gone to the Highland, they want a bank guarantee for this. So then he submits this, bank will ask him to submit the application, bank will evaluate it. See, look at the customer's creditworthiness and everything. Customer's creditworthiness and everything, look at it, okay. If the bank is satisfied, bank will give a guarantee, bank guarantee on behalf of this customer to the beneficiary. Bank will give, if everything is satisfied, do the analysis, evaluation, appraisal, and the bank is satisfied with this customer, then bank will give a bank guarantee on behalf of this customer to this beneficiary via the terms and conditions. Yes, bank guarantee. Give the bank guarantee. So now the bank guarantee is given. There all the terms and conditions have been mentioned. What is the maximum amount for what period, right? And if he fails, how much the bank will pay, everything is mentioned. Then, of course, what the bank guarantee is given to the beneficiary on behalf of the seller. Thereafter, he will go and get the milk powder, bring, sell. Actually, he will give postage a check to the beneficiary for that amount, for the amount of milk powder worth. He will give the check and bring, sell, and deposit the money to his account at the bank. On the day the check will come, it will get realized, yes, they will get the money. It will go on. This is the bank guarantee. Okay, now we read it. We come and we read it now. An irrevocable obligation of a bank, irrevocable. Once the bank is given the guarantee, it is irrevocable. Irrevocable. Bank to pay a specified amount of money if the applicant on behalf of whom the bank is giving the guarantee does not fulfill its contractual obligation. If he doesn't, yes, fulfill. Now, of course, he is taking the milk powder, bring, sells, and he has to deposit the money. The check will come and get realized and go. So, as long as it is going on, no problem. But if he fails to deposit the money, then the check will get returned. So, he is not paying the beneficiary. So, his guarantee does not fulfill his contractual obligation to the beneficiary. Then, bank has to pay. The beneficiary will claim from the bank based on the guarantee. The bank has to pay that specified amount. So once again, an irrevocable obligation of a bank to pay a specified amount of money. If the applicant on behalf of whom the bank has given the guarantee, bank is giving the guarantee, does not fulfill the contractual obligation to the beneficiary. Right. In that case, there are three parties: beneficiary, bank, customer, and the applicant. Bank, customer, or the applicant, and the beneficiary. Three parties. Sometimes people used to say first party, second party, third party. It may be confusing. So better to use parties. Who are the parties? Beneficiary, bank, customer, or the applicant. Then the validity of the guarantee. When the bank is giving the guarantee, there is a validity. This is valid till a specified date. So the bank will mention a specified date in the guarantee, bank guarantee. specified date. Until such time, it is irrevocable. So there is a specified date. Generally, this type of trade guarantees, the bank guarantee, this type of trade guarantee for 1 year. Trade guarantee for 1 year. And every year, it will be reviewed. Every year, if everything is going on, if the customer is good, it will be reviewed and renewed. So validity of the guarantee, there is a specified period. In case default by the customer, if the customer or the applicant default, in case default by the customer, bank will make a payment if a claim is made by the beneficiary only. So then, if there is a default, then the beneficiary will get affected. He will claim from the bank based on the guarantee. Based on the bank guarantee, the beneficiary claim from the bank and the bank will pay. And the bank will pay. So in case of default by the customer, bank will make a payment if a claim is made by the customer. Right. And guarantee, it is a written document. Bank guarantee, it is a written document. Written. It is a written document. So this is the bank guarantee. And after bank is paying, bank has to claim from the customer. Bank has to get that amount. So for this type of guarantee, bank is always asking for the deposit, cash deposit for this bank guarantee as the security. For this type of guarantees, bank is the security or the collateral for the purpose of collateral. Bank is asking a cash deposit from the customer to provide this type of bank guarantees. Now, because once they claim, so they have to pay. Bank can't wait. No, if they claim within the date, bank has to pay. So then, of course, since the bank has to pay, if the cash deposit there, the bank can get that cash deposit. This is bank guarantees for bonds. Okay. Again, all bank branches, there is a format for these bank guarantees. You all are working in a bank or maybe in a finance company. There are format for this type of guarantees, bank guarantees. Please get that format and go through, read it. And there are so many clauses. Many important things are there. So by reading that one, you will understand the real meaning of bank guarantees. So my advice, you may be working in a bank branch or maybe in a finance company. So please ask your manager or the credit officer for this bank guarantee format. There's a written format is there. Please go through that format and get the things very clear. Okay, please do it. Right. Types of bank guarantees. So there are various types of bank guarantees. So now, anyway, now when the bank is providing this guarantee, it is a service. Bank fund is not going. Bank fund is not going. So bank is charging a commission for this service. Bank is charging a commission for this. Since the fund is not going, bank won't charge any interest, but bank is charging a commission for this service. So this is a non-fund based facility. Non-fund based facility. But if the customer default, bank has to pay, then the fund is going. If the customer is default, then bank has to pay when the beneficiary is claiming. So then that's what I told you. When the bank is granting the facility, what type of entries, accounting entries, when the customer defaults and the bank pays to the, customer defaults, and when the beneficiary claims from the bank is paying, what sort of entries bank has to make. If the customer paybacks everything, once the guarantee is withdrawn, then what type of entries you have to make. So please, the next class, you have to tell me. Okay. type of guarantees and bonds. So one is domestic trade or payment guarantees. Domestic trade or payment guarantees. That's what we have explained now. Then contract guarantees or bonds. Then international trade or payment guarantees. Then financial or facility guarantees. So there are various types of bank guarantees and bonds. Domestic trade or payment guarantees, contract guarantees or bonds, international trade payment guarantees, financial or facility guarantees. We look at it. Domestic trade or payment guarantee. Letter of guarantee. This is the letter of guarantee. But I explained to you, this is the letter of guarantee. Domestic payment guarantee. Domestic trade or payment guarantee. Example, letter of guarantee. What I explained to you, letter of guarantee. Then contract guarantee. Then contract guarantee. This is for contractors. This guarantee for contractors. There are building contractors. There are road contractors. There are service contractors. Various types of contracts. We have explained just a previous lecture. There was type of facilities, type of customers. Under that one, I have explained you. I have told you about the contracts and contractors. So this is for the contractors. Contract guarantee we call it. Example. Now, Western Province, one of the schools, the education department wanted to construct a bank for a school building. Education department wanted to construct a school building. Right. So the education department, their people, they don't have people to construct. So they can't call somebody and do the construction. No. It's a government organization. Then what will? They have to call for tenders. We call it tenders. Tender. So for the construction of all tenders, tenders. For the construction of school building from the eligible contractors, they will call. So they publish in the papers. The Tamil, Sinhala, English papers, they publish papers. Calling tenders for the construction of eligible contractors can apply. And they may say the value of the construction value may be about 100 million rupees. Will be around 100 million, yeah. So the tenders, then the contractors, they will submit their quotation or bids. We call it bids. Contractors will submit bids. Quotation, their quotation. They will construct this building within what value? So for them to construct, what is the value? Yes, the department has to pay them. They quote, they give quote, and there are various other items, but whatever it is, you understand, there is a tender, calling tender, and the contractors will submit. There was some people, we will do it in 95 million, 96 million, 95.3 million, like that, various people, contractors, eligible contractors will submit their quotation or bid within the date. The last date for submitting the papers, within what date they have to submit, they will submit within that date. Now, the education department will have a tender board. Will have a tender board. So, in the tender board, there may be a technical committee There may be a technical committee. So they will go through the bids and quotation and eligibility of the contractors and everything. And finally, the tender board will select a contractor to do the contract. They will identify and select out of the people who have submitted their bid. They look at various things, their past performance, their financial statement and everything. They select a suitable contractor who submitted his tender for this purpose. They will select to do the contract and inform, yes, you have been selected. Here they will inform the contractor. Now at that time, the contractor may tell, no, Matanang make a current affair, I am withdrawing my tender. If the contractor say like that, if we say like that, what will happen? Then they have to look for another contractor to do the work. If that contractor also say, so it is endless. And again, they have to put a paper advertisement, call for tender. So in order to avoid this type of problem, the department will say, when the contractors submit their bids or quotation, they must provide a bid, a tender bond or bid bond. They must submit with a tender bond or bid bond for the value of, if it is 100 million, maybe about 1% or 2% depending. Say 2% mean 2 million rupees. Say 2 million rupees. Tender bond or bid bond from a bank, from an acceptable bank. The tenderer, that is contractor, should submit a tender bond or bid bond to the value of 2 million rupees with the bid or the quotation payment. If it is not submitted with the tender bond or bid bond, it will be declined. That bid or quotation will be declined. Why they are doing like that, asking for a tender bond? After submitting their bid or a quotation, they can't withdraw. If they withdraw after submitting, and if they are selected, if the contractor withdraw, no, Matanang current affair, withdraw karanang, then it is a problem for the school gender education department. They have to look for the contractor or they have to publish again, big problem. So what do? They will take this tender bond or bid bond. They will ask the bank provided this tender bond to pay them, because this contractor is declining to do the contract. For that purpose, this tender bond or bid bond, the education department is asking to provide it with the bid or quotation submitted by the tenderer, that is the contractor. So that is the purpose of tender bond or a bid bond. So the bank is providing. Similarly, okay, now the contractor agreed, he has submitted his bid bond and he has been selected to do the construction. He has agreed to do the construction. Then education department, okay, you will be doing this, you will perform this construction as anticipated correctly. So for that purpose, you submit a performance bond from the bank to the value of, they mentioned the value, that is about 10%. So that is for 10 million rupees, you have to submit performance bond. Then after submitting the performance bond, the tender bond or the bid bond will be released to the contractor. So next, the performance bond. That is bond to say this contractor will perform his duty correctly and as anticipated. Performance bond. That also, the contractor will go to his bank, explain, ask for a performance bond. So as earlier, bank will look at everything, or if he is a good customer and everything, they will give the performance bond. Similarly, advance payment guarantee bond, retention money bond, maintenance bond, the different stages the contractor has to provide to the tenderer, that is the education department, to perform various functions, So these are all contract guarantee where the bank is promising to the beneficiary on behalf of the customer, applicant, he will do this thing. If he fails, if you claim, we will pay you. Contract guarantee. I have explained to you tender bond and the bid bond and the performance bond, all other bond on your own. Please try to read and understand. Okay, right. That is contract guarantee. Then international trade or payment guarantee. International trade or payment guarantee. Here the best example is international international payment guarantee. Here the best, the other example is letter of credit, LC. Letter of credit. This is coming in the international trade program. In that module, international trade, letter of credit. This is for the importer will establish a letter of credit on the exporter through their bank. So this is for the importers. Now here is an importer. The importer's bank. On the other side, exporter. Exporter's bank. The importer want to import machinery from the exporter. He has negotiated with the exporter. Exporter has told him about the price and all the details, and he would have sent him a pro forma invoice. Pro forma invoice. Pro forma invoice for the machinery. Where the details of machinery and the price and everything is given. Pro forma invoice. When the machinery, if we want to import that machine, then of course he will go to his bank, that is importer's bank, and he will request them to establish a letter of credit on the exporter's bank for the purpose of importing machinery from the exporter. So that is letter of credit. You will really learn under this international module, but just for your information, I am telling you. You will learn this. A lot of things you have to learn in this letter of credit. There are terms and everything. Lot of things under international credit they will explain to you. So then, if the bank is satisfied this importer is a good customer and everything, right? So if it is an unknown person, then they will ask the importer, because it's a bank guarantee. Bank is giving the guarantee to the exporter bank. You send the machinery to the exporter, we will pay you. So bank is guaranteeing. After guaranteeing, bank can withdraw. Irrevocable obligation. So if he is an unknown customer, then bank will ask him to deposit the entire value. Deposit, if the machinery is about 10 million rupees, he deposit the 10 million. Plus the other charges, other import duties and other thing, yes, he will ask the customers to deposit. So if he is a known customer, a well-known customer, very good customer, then he will maybe ask them to establish certain percentage of the value. Then the bank will establish a letter of credit, that is promising the exporter's bank. Through the exporter, you send the machinery, we will pay you. So that is letter of credit. You will learn about this letter of credit in the international module. After this one, yes, they may have the international module, and certain things I will explain to you about the letter of credit, that is purchasing, bills purchasing and bill discounting under letter of credit or documentary credit. I will explain you later. After you understand the details of letter of credit, I will explain you. Yeah, I will be taking some more lectures. I will explain to you. So this is international trade payment guarantee. So letter of credit also one of the bank guarantee, that is called as international trade payment guarantee, letter of credit. And then financial or facility guarantee. This is financial or facility guarantee. What is this guarantee? Now, in Sri Lanka, there is a bank, as an example bank. A customer wants an SME facility. SME facility. SME facilities, some customers take, because there are concessional terms and conditions. Interest rate may be low. Repayment is very flexible repayment period, like that. And other terms and conditions are very flexible. So people go for SME facilities. Okay, the bank has done the appraisal, all the risk and everything evaluated. Bank is satisfied with the proposal. Bank said, okay, we will give you the facility. Maybe 5 million rupees facility. Bank will give you. Then bank will ask, what is the security you can provide? What sort of security you are going to provide? Now the customer has to provide. The customer says, yes, I am having 5 million rupees fixed deposit, FD, for 5 million rupees with a finance company. I am having the deposit with the finance company because they give me higher rate of interest. Higher rate of interest for my deposit. Because of that one, I am keeping my 5 million there. And I have come to you because you are giving me the facility at the low rate of interest. 5 million. I will provide a guarantee from this finance company. I will provide a guarantee from this finance company. From the finance company for 5 million rupees, I will provide a guarantee. Okay. If the finance company is acceptable to this bank, there are some finance companies may be problematic, but if this particular finance company is acceptable to the bank, then the bank can accept the 5 million rupees guarantee from the finance company to the bank on behalf of this customer. If the customer defaults, they will say, we will pay you. So this type of guarantee is called as financial or facility guarantee. One financial institution is providing guarantee to another financial institution on behalf of their customer who is getting a loan facility. If he default, they will promise they will pay. This type of facility is called as financial or facility guarantee. There is another example also we can look at, that is a foreign company, or maybe Japan. company doing a project in Sri Lanka. They go to a bank under with the central bank approval. The central bank approval. They are doing a project in Sri Lanka. They go to a bank for a facility, maybe 100 million, maybe in foreign currency or local currency, maybe facility they are going. Bank. So bank is see everything is okay, but this is an unknown company. They may ask, can you provide a bank guarantee from your own bank from Japan? Can for this facility, can you provide a bank guarantee from your own bank in Japan? Then in that case, from Japan, bank, they may be customers of the Japan bank. If they provide a bank guarantee, and if the bank is also acceptable to this bank, if the bank, Japan bank also acceptable to this bank, then this is a financial or facility guarantee. That can be financial or facility guarantee. That a foreign bank is guaranteeing a company locally to a bank, to a local bank or a Sri Lankan bank to provide loan facility that Japanese company. And if the Japanese company fail, the Japan bank will pay. So this is the financial or facility guarantee. Bank guarantee. So we have seen the facilities and advances. Advances and facilities. There are two types major, that is fund-based facilities or advances. Other one is non-fund-based facilities or advances. We have seen the examples. We have seen the examples. These are very basic things you should know. Now, type of advances based on repayment. Based on repayment also, we can classify the advances. One is short-term loan. Any loan payable, repayable within 12 months or within 1 year is called as short-term loan. Any loan repayable within 12 months is called as short-term loan. Then term loan. There are two types of term loan, one in medium term and long term. Any loans repayable between 1 year and 3 years is called as medium term loan. Any loan repayable more than 3 years is called as long term. This is central bank definition. Short-term loan repayable within 12 months. Term loan, there is medium term or long term. Medium term from 1 to 3 years is medium term loan. If it is more than 3 years, then it is long term loan. But in India, it is something different. Short-term loan means in India, any loan repayable within 3 years is short-term loan. Any loan repayable between 3 years to 5 years, it is medium-term loan. Any loan repayable more than 5 years is long-term loan. That is the Indian example. So I have told you just for you to compare the Sri Lankan example and the Indian example. Then type of loan based on securities. Type of loans. The banks are taking securities. Banks are taking securities or collateral for the facilities. There are various types of collateral or securities. One is guarantee loan or ODs. So loans or overdrafts can be provided with a guarantee. Guarantee loans. Yes. Guarantee of personal guarantee. Guarantee of two or generally 2 or more people obtain a guarantee of 2 or more people for a loan facility of a customer. Yes, it's a guarantee loan. Sometimes the corporate guarantee by a corporate guarantee. So that is a company guarantee. Can obtain a company guarantee. That is guarantee loan. Then mortgage loans or overdraft facilities. Loans or overdrafts can be granted with mortgage of properties. Mortgage of properties. By the mortgage of properties, bank can grant loans or overdrafts. Overdraft means PODs, permanent overdrafts. So there are two types of properties: movable properties, immovable properties. When we say immovable, what are immovable? Land, building, machineries fixed to the land, also immovable, considered as immovable. Land, buildings, machinery fixed to the land, immovable. Another one, movable. Machinery is not fixed to the land. Vehicles, stock in trade. Stock in trade means keeping the stock for the trading purposes. Keeping the stock for the trading purposes. Maybe garment stock, fabric stock, sugar stock, or flour stock. Yes, stock. Spare parts, stock of spare parts. Yes. So these are movable items. The mortgages. So what is mortgage? Mortgage is governed by Parliament Act. Mortgage Act. You must get what are the number, what are the dates of these mortgage acts. That is, you have to do on your own. There are mortgages those are governed by Mortgage Act, and there are amendments to the acts also. So you must find out mortgage acts. What is the number? What are the dates? Actually, later there is securities. Under securities, they will explain to you what are the. But anyway, now I want you to find out on your own. Mortgage acts, there will be a number of the act and the year of the act that you have to find out. Mortgage Act number such and such of what is the year. Then there are amendments also that you have to. So the mortgages by the financial institutions are governed by these mortgage acts. So what is mortgage? The mortgage is when a borrower owned a loan facility from a financial institution by providing his assets, maybe immovable asset or movable asset, as a security. And if you obtain the facility, we call it as mortgage facility. Once again, when a customer wants to obtain a credit facility from a financial institution by providing his assets, maybe immovable asset or movable asset, as a collateral or as a security, and borrow, then it is called as mortgage facility. So in that case, through documents, we call it mortgage bond, bank is creating a charge on those properties. Bank is creating a legal charge on those properties provided as securities and grant the facility. When the facility is settled by the customer, the bank will release the legal charge on that property. When the facility is settled by the customer, bank will release the legal charge on the property. If the customer default of that loan, then bank will take certain legal procedures and auction the property and sell the property and recover its loans and the interest due. This is mortgage. So this is for the purpose. Later, under securities, you will learn more about this mortgage. The procedures, various things you will learn. But now you must know a basic thing of a mortgage facility, basic thing of a mortgage facility. The mortgage, and with the mortgages, you can grant loans on OD, mortgage of immobile, mortgage of movable, mortgage of immovable mean land, building, machinery fixed to the land, mortgage of movable mean machineries not fixed to the land, vehicles, stock in trade, etc. Those are mortgages. When we say mortgage, if a customer provides his property, maybe immobile or movable as a security or as a collateral to the bank and borrow sum of money, then we call it is mortgage facility, where the bank through legal document create a charge on the property provided as security. And when the customer pay back the loan, then the bank release the charge on the legal charge on the property. If the customer default, bank follows certain legal procedures and auction the property, and that means sell the property and recover the capital and the interest due. This is mortgages. So now I want to ask you a question. Just think about it. So under mortgage, who is the owner of the property and under whose possession and control the property? Under mortgage, who is the owner of the property and who is having the possession and control of the property? Anyone? Under mortgage, who is the owner of the property? Who is having the
possession and
yes, please.
Possession and control is with the bank, but the owner remains as the owner, as there is no transfer to the bank, but it's only a mortgage.
Okay, fine. This is mortgage. Fine. Yeah, mortgage. The owner is, yes, the owner of the property. He is not transferring the property. If he transferred only, the property won't be in the owner's, no, the owner. But even possession and control also, it is not with the bank. After mortgage, his house, the customer is living in that house. After mortgaging his vehicle, customer using the vehicle. So, ownership is also with the customer. Possession and control also with the customer. Bank is having a legal charge on the property. Bank is having only the legal charge on the property. If the customer default through the legal charge, bank will follow certain procedures and auction the property, that is sell the property and get its capital and the interest due. I hope everyone will understand, even after mortgage, ownership is with the customer and possession and control also with the customer under mortgage. Now, this mortgage is called as primary mortgage. Even thereafter also, this property can be mortgaged. If there is the value is there, the property can be mortgaged. Second time or even third time. We call it secondary mortgage, tertiary mortgage, like that. Primary mortgage, secondary mortgage, yeah. The same customer can mortgage it second time or third time. So that is secondary mortgage, tertiary mortgage. And then another important thing, there will be a mortgage bond executed by a legal professional. When the property is mortgaged, the mortgage bond should be executed. So that is by the legal professional, and that property, that mortgage bond should be registered with the land registry within 21 days of the date of execution. So the mortgage bond should be registered with the relevant land registry within 21 days of the execution. This is a must. And then, okay, yeah. Then there is another thing also, I must tell you. There is another term, concurrent mortgage. Another term, concurrent mortgage. Sometimes if the loan facility is very big facility, big, 2 or more banks can grant that facility to a single customer. To a single customer, 2 or more banks can grant the facility. We call it syndicate loan facility. Syndicate loan facility. So in that case, the financing organization banks, they have the mortgages. We call it concurrent mortgages. So everybody has the primary mortgage. Every bank will have the primary mortgage. It is concurrent mortgage, where 2 or more banks finance a single institution. They take the property as a security, and all will have the mortgages. All banks will have the mortgages. We call it concurrent mortgage. And another thing, if the customer is a company, I have told you about mortgage bond that should be registered with the relevant land registry within 21 days of the execution of the mortgage bond. So in the case of companies, that mortgage bond should be registered with the registrar of companies also. These are very basic things you may learn when the securities module. There's a separate lecturer will be doing the security modules on securities. So that time you will learn, but these are very basic things you should know. The execution and the registration of the mortgage bond within 21 days from the date of execution in the relevant land registry that should be registered. In the case of company, the customer is a company, it should be registered with the registrar of companies also. So this is mortgage. Then the pledge loan or ODs. But anyway, in the mortgages also, there's one more thing I must tell. The property value. Property value. So before providing the mortgage facility, the property should be valued by a professional valuer. Property should be valued by a professional valuer. And there are 3 types of values. One is market value. Then for sale value. Insurance value. So this property should be valued by a professional value. But the banks may review it, whether it's done by the professional value or everything. The banks will review, maybe at the head office, they will review these values. But there are 3 values. Market value. So what is the market value of the property? So when this property, if it is put for sale in the market, maybe for about 3 or 4 or 4 weeks, what is the value the people will offer for this property? That is market value. So the professional valuer, when he submits his valuation report, he mentioned various other things, the situation, type of property, everything, boundaries, what is the north, south, west, all those details, and finally give the values. Market value, he will give. And for sale value, if it happened to sell it urgently, urgently if we want to dispose, what is the value you can offer? That is the for sale value. He will mention. Then the insurance value. If there is a property, if there is a property in the sense, if there is a building in that land, if it is get affected, that building, to reconstruct that building, what will be the value? Reinstating the value. If there is a building, if it get affected, destroyed, to reconstruct that building, what is the value? That is insurance value. For that value, that property should be insured. So these are the three values. Actually, bank will, when bank advance, they will consider the for sale value. The bank also, if the customer defaults, the bank, if the bank want to sell this property, bank has to sell it immediately. They want to dispose. So in that case, what is the value? The for sale value bank will take for them to decide the loan amount. Generally, out of the for sale value, bank will may provide, say, about 60% as a base. Depending on the customer, bank may give more and more, even 75% of the for sale value, or 80%, or even 100% of the for sale value, if the customer is good. So we call it rate of advance. This is called as rate of, I don't know, can you see? I don't know whether you can see. Rate of advance. Rate of advance. Rate of advance. So say about, start from 60% and above, depending on the customer. The customer is good, even they may consider up to even 100% rate of advance. So these are for mortgages. What is that? Yes, up to. Right. So this is mortgage. So you will have now a basic idea of mortgage facilities. Mortgage of immovables or mortgage of movable, you will have a basic idea. Right. Now the pledge loan. Pledge loan. Even ODs also you can. With the pledge. This is another type of security. Pledge facilities. What is pledge facility? When a customer hand over his movable asset to a lending institution as a collateral or security and borrow against that asset, it is called as pledge facility. Here the security is pledged. I will repeat it. When a customer hand over his movable asset as a security or as a collateral to a lending institution and borrow against that movable asset, then it is called as pledge facility. Pledge facility. There's one of the best example. Yes, anyone can say what is the best example for this pledge facility? Anyone, can you say?
Paddy.
Sorry?
Paddy.
Very good.
Paddy.
Very good. Paddy is a best example. Yes, but only certain bank branches, certain areas, only this facility is granted. Very good. Yes, very good. This is another example. Everywhere the bank is granting. Almost all branches, all banks, all branches, they are granting this pledge facility. Anyone else?
Lease.
Gold
Leasing.
loans.
Huh?
Gold
Leasing.
loans.
Sorry, it is not clear to me.
Gold loans.
What loan?
Gold.
Gold. Oh,
Pawning.
fine. Yes, 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 fine. Yes. Pawning.
Pawning stocks.
Pawning. Oh, gold loan. Gold loan. Pawning. Pawn is a movable asset. Customer is handing over to the bank or financial institution. Customer is handing over as a security and borrow. So this is pledge facility. So one example, pawning. Other example, as other gentleman told, Paddy, and there are so many other items. We will see what are the other items. Pawning is governed by pawn brokers ordinance. Very old ordinance. Pawning is governed by legally pawn brokers ordinance. As I told you earlier, what is the number, what is the year, you have to find out. I will ask next class, please. I will name somebody and ask, so you have to answer me. Pawning, yes, ordinance, pawn brokers ordinance. What is the number? What is the year? You have to. There's a small exercise. There's a small exercise. You can refer some books and you can find out. Small exercise. The paddy pledge, that is governed by Mortgage Act. Mortgage Act. Again, number, year, Mortgage Act. So, Mortgage Act, under Mortgage Act, mortgage is also coming, pledge also coming. So, there are two types of, one is pawning also pledge, because we are handing over the movable asset to the bank as a security and borrowing. And here also, paddy pledge, here also handing over the paddy stock as a security to the bank and borrowing. But pawning is governed by pawn brokers ordinance. Paddy pledge is governed by paddy and other items. Unperishable item. Unperishable item. Unperishable. Perishable item. Mortgage Act. Okay. Now again a small question. Under pledge, who is the owner of the movable asset? Under whose possession and control the movable asset? First, somebody tell me who will be the owner of the
Owner is the customer.
Okay.
And possession is with the bank.
Bank. Very good. Very good. May I know your name?
Brinda.
Sorry?
Brinda.
Brinda. Very good. Very good. Yes. Yeah, as a name, as we explained, customer is handing over the movable asset to the bank. So the possession and control is with the bank as a security and customer is borrowing. And the ownership is still with the customer. When the customer pay back, bank has to return it. The gold article, when the customer pays, the bank has to return the asset. Similarly, when the paddy pledge, when the customer pays, bank has to release the paddy stock. So this is pledge. But mind you, please keep it in your mind, this is for movable. So local and imported. So local also paddy, then maize, that type of thing. We can pledge and the customer can obtain the facility. And the imported items also, we have explained to you LC, establishing the LC, when the item is coming, after items has come, there are you will learn later, but after that, you have to get it clear. The imported item, you have to clear it. So for that one, you can obtain pledge facility from the bank to clear the item and keep it under bank control. You are importing textile stock, or you are importing garment stock, or you are importing spare parts stock, you are importing motorcycles, you are importing push bicycle, even cars you are importing, various items you are importing under LC. You have to get it clear. So for the clearing, you have to pay. You have to pay, and then only you can clear the imported goods. For that purpose, you can obtain a pledge facility from the bank, and the stock will go under the bank control. You will, yes, get the facility, clear the goods, and the stock will go under the bank control. When you sell, you pay and release the goods, and you can sell. So here under not only paddy, maize, spare parts, cycles, motorcycles, vehicles, fabric stock, stock of garment, etc., etc., etc. These are coming under import facilities. This will come under import facilities. So this is pledge. This is pledge. So you can obtain a loan, or similarly you can obtain a OD facility also. So I must tell something about the paddy pledge. I must tell something about the paddy pledge. Paddy is a seasonal crop. Paddy is a seasonal crop. Once in 6 months generally. Maha season and the Jala season. Maha Kanya, Jala Kanya. So once you get the harvest, paddy harvest, you have to wait for another 6 months to get the paddy harvest again. By milling the paddy, you will get the rice. But rice we need every day. Our staple food is rice. So people need rice everywhere. So the paddy miller has to keep a stock of at least 6 months, at least 6 months stock of paddy, the paddy miller has to keep with him. Because daily he has to mill and supply the rice to the consumers. So you must have a 6 months stock. Because next harvest will come after 6 months. So 6 months stock is a very huge value. Now the big quality paddy mills are available in Polonnaruwa, Anuradhapura, and to some extent Ambara, but mostly Polonnaruwa and Anuradhapura. See, these are very modern paddy mills are there, very big capacities. So they have to keep the stock of paddy stock for 6 months. That may be the value of about more than 1,000 million worth of paddy stock they have to keep. So they may not have that amount of money. So they have to borrow from the banks. For them to borrow from the bank, they have to provide suitable securities. Maybe they are building mills and everything am already mortgaged. So they may not have other securities to provide to borrow. So here they are providing the paddy stock as a security to the bank, hand over to the bank and borrow again that paddy stock. So this is the paddy pledge facility. So now the paddy stock should be under bank control, possession and control. The paddy stock provided by the customer as the security to the bank should be under bank control, possession and control. Whereas the bank possession and control mean in Ambara, Polonnaruwa, Anuradhapura, bank should have a big warehouses. They don't have. So banks are using the customer's warehouse to stock these paddy stock. The customer, all paddy millers have very big warehouses to stock the paddy. So banks are using these customers' warehouses to stock these paddy stock. So then legally it is not correct, no? Legally, pledge means it should be under bank possession and control. How can the bank keep it under customers' warehouses? So, what the bank is doing, bank will execute a lease agreement with the customer concerned. Customer is leasing that warehouse to the bank for a nominal, and a document is executed. Legal lease agreement is executed between the bank and the customer, where the bank takes that warehouse of the customer on lease for a nominal payment. Now, legally, when the stock is kept in that customer's warehouse, legally, it is under bank possession and control. So there is an important document when the bank is providing pledge facility to a customer, that is, the customer's warehouse is leased to the bank legally. There the stock is kept. And then the lock and key, it is purely under bank control. So the bank, anyway, bank give one key to the customer for the purpose of establishing an understanding. Otherwise, bank can keep all the keys, lock and key with them. But bank is giving a dual control. It is under dual control. So it is not legally, but on the basis of understanding of the customer, then both parties only can open and take the stock out or put the stock in. So this is another aspect. Before granting the facility, bank will examine the warehouse whether everything is clear, no leak proof or no rat proof. If the rat proof, leak proof, all the locks and key doors are firm, right? So they examine, and some cases bank will put a board. This is bank leased out property. This property is leased out to the such and such bank. So the people know. So this is leased to the bank, and the bank stocks are there. So these are certain procedures followed under pledge law. And the bank generally advance the rate of advance against the pledge property, pledge that is pledge paddy or any other perishable, non-perishable item, 50% of the value of the stock the bank provide as the finance. Say 50%. Okay, so this is pledge loan facility governed by Mortgage Act. So as I told you, what is the number and the year of the act, you have to find out. Then another facility, hypothecation loan. Hypothecation facility. The meaning of hypothecation is, again mortgage. Meaning of hypothecation. If you go through the mortgage bond or mortgage act, always the term like this: mortgage and hypothecate, mortgage and hypothecate, mortgage and hypothecate. So this is the wording. So hypothecation also means it is mortgage. But how this hypothecation loan came? And it is applicable to movables. It is applicable to movable. So hypothecation of movable stock in trade is TOC. Stock in trade. This is the one. The mortgage of stock in trade may be stock of sugar, stock of flour, stock of various other items, stock of garments, stock of fabrics. Mortgage of stock in trade. Use the word hypothecation. So mortgage of stock in trade is called as hypothecation loan. Actually, this term is used by Bankers Loan, People's Bank, Pan-Asia Bank, and the central bank also. They use this term hypothecation of stock in trade. All other banks are using mortgage of stock in trade. Both are same. So this hypothecation is for movable, especially stock in trade. The hypothecation of stock in trade. Once again, Bankers Loan, People's Bank, Pan-Asia Bank, these are using. But other banks, Sambat Bank, DFCC Bank, all these banks, they are using mortgage of stock in trade. So it is mortgage. So as I told, explained for this mortgage facility, this is applicable to these mortgage hypothecation facilities as well. This hypothecation facility is given even for the local item and for the imported items also. Under the LC, as I explained, under pledge loan, after LC to release the goods, you want the facility, either you can get a pledge loan facility or you can get a hypothecation loan facility. You can get the things out. So under hypothecation, ownership and possession and control both are with the customer. Under hypothecation, possession and control and ownership both are with the customer. Okay, yeah, this is hypothecation loan. So that is mortgage of movable, that is mortgage of stock in trade. Then there is another facility, series of loans or revolving credit facilities. Series of loans or revolving credit facilities. This also, the series of loans, the name is being used by Bankers Loan, People's Bank, Pan-Asia Bank. Whereas other banks use the term revolving credit. Other banks use the term revolving credit. Sambat Bank, Commercial Bank, NDB, then DFCC, they all are using the term revolving credit. Both are same, meaning both are same. Series of loan, revolving credit. Right, series of loan. Now we take an example. There is an industry. They are importing raw materials. They are importing. So industry, they need raw material. Maybe they are importing from India. Every month they have to import. Say 1 million worth. So first month, second month, third month, fourth month, fifth month, sixth month, seventh month. It goes on. Every month they have to import 1 million worth of raw material. Raw material they have to import every month. It goes on, 1 million. So they are using this raw material and producing certain item. Yeah. 1 month, third month. So the production will come from this raw material after third month. Production is coming after third month. Maybe here the production is coming. So they are getting the first month 1.5 million production. And thereafter, every month, they are getting 1.5 million of products. It goes on. So now we understand every month they have to import. And the production comes after 3 months. So here 1 million they need, here 1 million they need, here 1 million they need. So altogether 3 million rupees they need. Altogether 3 million they need. So they need a bank finance. So how to finance this one? There may be various options, but so 1 million, 1 million, 1. So loan facility is approved for 3 million rupees. Limit 3 million rupees. Loan limit 3 million approved. And how is the repayment? After 3 months, that is from 4th month onwards, they have to pay 1 million. Every month they have to pay 1 million plus interest on the accrued interest or on the amount, because here every month they have to pay the interest. Initially, they have to pay. Given the grace period is there, during the grace period, they have to pay the interest. And the repayment is from 4th month, they are getting before the 4th month, they are getting 1.5 million income. So with that one, from 4th month onward, they have to pay 1 million plus the interest they have to pay. Then what happened? Yes, then they need. So they got only 1.5 million. Out of that 1 million they pay, they will pay the interest. So the balance, of course, they can utilize. But again, they need 1 million to import. So again, they can get. Now, since they have paid for 3 million, this will be reduced to 2 million. This will be reduced to, this is 3 million has become now 2 million because 1 million is paid. So again, they can borrow, take. So this is a revolving credit or series of loan where 3 million limit is approved and revolving nature. And the repayment from 4th month onwards, every month 1 million plus interest paid. And then again they can take the withdraw 1 million. They pay 1 million plus interest and again they can take for the importation. So this is series of loan or revolving credit facility. Now, so this is a long-term loan. This loan can go till the company, till the manufacturing process is going on. There is a industry is going on. As long as the industry is going on, this facility can be go on. So it's a long-term loan, but repayment on short-term. So repayment on every month from the 4th month onward, repayment every month. So long-term loan with short-term repayment. This is series of loan or revolving credit. Since this is a long-term loan, bank provide this facility under secured under immovable. Under immovable security, bank will obtain and provide. And apart from that, annually this facility will be reviewed. The meaning of review, I have told you, that is whether we can allow this facility to go on as a new loan, whether we can allow this facility go. So for that purpose, again, you will evaluate it. You do a detailed evaluation and allow whether you can allow this facility to go on. This is reviewing the facility annually. You will review it. This is the series of loan or revolving credit facility. And then another loan based on the security, trust receipt loan. This loan also granted for movable. Trust receipt loan granted for movable. Especially stock in trade, raw materials for that one. Trust receipt loan. Okay, what is trust receipt loan? This is also very popular facility. TR loan, popularly known as TR loan, trust receipt facility. So now, what is trust receipt facility? When a customer purchase goods for the purpose of manufacturing or trading, customer will enter with a bank with a trust receipt agreement. With the trust receipt agreement. I am repeating, when a customer purchases raw material or goods for trading purposes or manufacturing or trading purposes, he borrow from a bank and enter a trust receipt agreement with the bank and borrowing. In the trust receipt agreement, the customer accept bank is the owner of these goods. In the trust receipt agreement or trust receipt document, customer agrees the bank is the owner of the goods. And the bank releases the goods to the customer on trust for him to sell or use and repay the loan. This is trust receipt loan. I am repeating it. Please try to understand. What is a trust receipt loan? When a customer purchases goods for the purpose of manufacturing or for the purpose of trading. For the purpose of manufacturing or for the purpose of trading, he entered into an agreement with the bank, a trust receipt agreement, where customer agrees bank is the owner of the goods. And the bank releases to the customer on trust. The bank releases the goods to the customer on trust for him to use or sell and repay the facility. Then this facility is called as trust receipt loan. So goods mean the movable goods. Trust mean movable goods. This is trust receipt facility. Movable goods. This is governed by Trust Receipt Ordinance and again Local Trust Receipt Act. There are two legal, one is Mode Ordinance, Trust Receipt Ordinance, and other one Trust Receipt Local Inland Trust Receipt Act. So this is applicable to local goods as well as imported goods. Locally also acceptable, applicable. Imported goods also it is applicable. Trust receipt loan. Now please tell me, somebody, under trust receipt loan, when a customer purchases goods, who are the owner of the goods and who will have the possession and control of the goods? Who are the owners of the goods? Who will have the possession and control of the goods?
The bank. The bank.
Sorry?
The bank.
Yeah, what is bank?
Bank is the owner
of the
because
goods.
as the customer has accepted, the bank has owner.
Okay, yes.
And the
It is
possession is also.
yeah. Okay, yes, go ahead.
And the bank possession is also with the bank.
Yeah.
Because bank is releasing the goods to the customer for his use and repay.
Okay, okay, right. So now, customer agrees in the trust receipt document. In the trust receipt document, customer agrees that bank is the owner. Customer has purchased with the bank loan. Customer has purchased with the bank loan. But in the trust receipt document, customer agrees bank is the owner. And the bank on trust releasing the goods, the movable goods to the customer on trust for him to sell or use and repay the loan. So this is trust receipt document. This is very popular facility, yeah, but high risky facility. So now for the local goods also we can give the trust receipt facility, but those days mainly it is given, this facility was granted for the imported goods. This facility was granted for the, yes, like under LC, after importing, you have to clear the goods. For that one, so many facilities bank can grant. We have seen now. Pledge facility can be granted, where the goods will be under control of the bank, possession and control of the bank. Hypothecary facility also can be granted to clear the goods, where the ownership and the control both with the customer. Even trust receipt loan also can be granted to clear the goods. So where the bank is the owner, possession and control with the customer. So these are the facilities, trust receipt facilities. Okay. Now anyway, now 12:35. Yes, you also have to go for your lunch. Maybe there are some more things we may follow in the next class. Here, of course, today I have given you some work, small work. One is the accounting entries and bank guarantees. The accounting entries you have to find out, and then certain acts and yes, ordinance, the number and the dates of those ordinance and the act you have to find out. And another thing, last time I have given my contact number. If you have any doubt or clarification, you can contact me. Thank God nobody has contacted. So that means you all understood what I explained. Maybe this time also I won't get any calls or because I hope you all will understand. If you have any doubts, anyway, you can contact me. Right. So some more things we had to complete it, other types of advances, terms and conditions. Yeah, anyway. Okay, we will continue in our next classes. That is next Sunday. Okay. If you have any doubt or clarification, please, yes, you can communicate with me. Thank you very much. Now we close the session now. We will continue coming Sunday. Thank you very much. Thank you.